Good morning. I'm Brian Smith, the Deputy Assistant Secretary for Federal Finance at the U.S. Department of the Treasury. Today's conference will focus on key topics related to the resilience, liquidity, and future of the U.S. Treasury market. We're delighted to have several speeches and remarks lined up from senior officials across the joint member agencies, including New York Fed President John Williams, Board of Governors of the Federal Reserve System Vice Chair Michael Barr, U.S. Treasury Undersecretary for Domestic Finance Nellie Liang, Securities and Exchange Commission Division of Trading and Markets Director Haoshang Zhu, and Commodity Futures Trading Commission Chairman Russ Benham. We also have 3 panel discussions with industry leaders, market practitioners, and members of the official sector. The 3 panels will be moderated by David Bowman, who's a Senior Associate Director at the Board of Governors, Ellen Correa-Golay, Treasury Markets Advisor at the New York Fed, and Josh Frost, Assistant Secretary for Financial Markets at the U.S. Department of the Treasury. These panels will cover a broad range of topics, including non-centrally cleared bilateral repo, assessing recent Treasury market resilience, and looking to the future of the Treasury cash market. And I'll now turn it over to Brett Rose, who I'll be sharing today's MC responsibilities with.
Thanks, Brian. My name is Brett Rose. I'm the head of the Treasury and Mortgage Markets Desk here at the New York Fed, and it's my pleasure to welcome everyone here for our 9th annual conference. We're really looking forward to today's event and a lively discussion. Given the increased focus on Treasury market resiliency over the past several years, we think this is a particularly timely event. We'll be getting started very shortly with the panels Brian just noted, but I'll go through a little bit of the logistics first. First of all, today's conference is being live streamed to the public via webcast on the New York Fed events website, and a recording will be posted soon after the conference is over. We also have several members of the press here in person, so that means that this conference will be considered on the record unless specifically noted otherwise. We'll also be doing audience Q&A at a few different points during the conference. And we will let people know when the Q&A sessions are happening. And when they do, please just raise your hand and we will get a mic to you. Then please introduce yourself and your institution. And while we're really encouraging a lively Q&A session, we'll note that this is only available to in-person attendees. In terms of logistics, hopefully you were able to pick up an agenda and bio book for the conference on your way in. If you didn't, they should be right outside or on the first floor. There's also a coat check outside. Hopefully most of you found that on the way in. And make sure you don't grab everything before you leave here by the end of the day. We'll also be having a luncheon and reception, which is down on the first floor in the Liberty Dining Room. We'll help guide you down there at the appropriate times. There'll also be 2 scheduled breaks, one in the morning and one in the afternoon, which will be right outside in the reception area you were just in. Also, if you have questions, we do have conference support staff here. They should have kind of ribbons on the bottom of their name tags, although some will say staff and some will say speaker. You'll probably have better luck with staff. So with that, we will move on to our first speaker, who is Michelle Neal. Michelle Neal is the head of markets here at the Federal Reserve Bank of New York and has over 20 years of leadership experience in the financial sector. Before joining the New York Fed, she held senior leadership roles, including head of US FICC and Global Senior Relationship Manager at RBC Capital Markets, CEO of markets at BNY Mellon, and in several leadership positions at Deutsche Bank, Nomura, and RBS. With that, I'll welcome Michelle Neal.
Thank you, Brett. Good morning, everyone. It's a pleasure to welcome you all here to the Federal Reserve Bank of New York, including those joining through the live stream, to the 2023 U.S. Treasury Markets Conference. On behalf of the New York Fed and also our conference co-hosts, the U.S. Department of Treasury, the Board of Governors of the Federal Reserve System, the U.S. Commodity Futures Trading Commission, and the U.S. Securities and Exchange Commission, thank you all for participating in today's 9th annual conference. As we've often noted in this forum, the U.S. Treasury market is the deepest and most liquid securities market in the world. It plays a critical role in the global economy, serving as the primary means of financing the U.S. federal government, serving as the primary means, a safe investment benchmark and hedging vehicle for global investors, a risk-free benchmark for other financial instruments, and an important market for the Federal Reserve's implementation of monetary policy. Over the course of the day, we will be highlighting key developments, policy issues, and recent trends in the Treasury market, including consideration to encourage continuous improvements in this critical market's functioning and resilience. The U.S. Treasury Market Conference is an important annual forum for the information sharing and dialogue between the official sector and the public, which is key to advancing our common understanding of the Treasury market. Today, as part of that dialogue, I would like to provide some brief remarks on the important role that data transparency plays in the supporting of market functioning and resilience, and thoughts on the future. Before I go further, please let me remind you that the views I express today here are my own and not the views of the Federal Reserve Bank of New York or the Federal Reserve System. Increased transparency of the Treasury market transaction data can help build knowledge around trading dynamics in the market and can improve investor confidence by allowing investors to analyze executed transactions instead of observing indicative quotes. The reporting of executed prices improves price discovery, which can reduce trading costs, improve liquidity, and potentially attract new entrants to the market. Recently, there have been some important steps towards increased data and transparency in the U.S. Treasury market. And earlier this year, FINRA began releasing daily aggregate data on Treasury market transactions. And at this conference last year, the U.S. Department of the Treasury announced plans to release trace transaction data for on-the-run nominal coupons. However, even with this progress, gaps in transparency still remain. In March, the Treasury Markets Practices Group, known as the TMPG, which is sponsored by the New York Fed, put out a white paper on data availability and transparency in the U.S. Treasury market that identified several gaps, particularly in the dealer-to-client cash market and the repo market. Looking at the gap in the cash market specifically, there appears to be an opportunity for improvement in providing transparency around transaction-level data. I am looking forward to the increased transparency in on-the-run transaction data that I mentioned earlier. And looking further ahead, we should consider whether to take additional steps towards increased transaction transparency across the Treasury universe, especially for the less liquid segments of the Treasury market, such as the off-the-run market, where transparency is currently limited. The off-the-run market was the center of much of the dash for cash selling of Treasuries that occurred in March 2020. Yet there is little data in off-the-run trading available to the public, making it challenging for academics and others to study such stress events in detail. As we think about increasing transparency, it is important to exercise continued prudence. There can be reasonable concerns about public transaction data, such as potential challenges that may create issues around intermediating certain large trades. However, the success of public trace data transparency in the mortgage-backed securities and corporate bond markets provides guidance on how data can be shared without negatively impacting the market, such as displaying data with appropriate mitigation measures like time delays and capped trade sizes. In fact, academic research has generally found that the introduction of trace data transparency in these markets resulted in increased competition and reduced transaction costs. Additionally, we can learn more about how to structure public releases of data on less liquid securities by studying the future release of on-the-run transaction data. Given transparency into Treasury market activity can support the market's many important roles as a risk-free benchmark for financial instruments, as a liquid investment and source of safe collateral, as a channel for the implementation of monetary policy, and of course, as a cost-effective mechanism to help finance the U.S. government activities. Today's conference provides an excellent opportunity to discuss topics like this one and bring together diverse perspectives from across the Treasury market and the official sector and the public to promote the Treasury market resilience efforts. Thank you for joining us today, and I hope you have a great conference. Thank you.
Thank you, Michelle. It's now my pleasure to welcome John Williams as our first keynote speaker of the day. He's the president and CEO of the Federal Reserve Bank of New York, where we are here, a position he's held since 2018. As part of his role, he also serves as the vice chair and a permanent member of the FOMC. Before joining the New York Fed, he was president and CEO of the San Francisco Fed, and prior to that, the director of research there. And he began his career as an economist at the Federal Reserve's Board of Governors. With that, please join me in welcoming President Williams.
All right, good morning, everyone. It's great to see so many friends and colleagues for this conference, which has been, obviously hugely successful now in its 9th year. Bringing together the joint member agencies and other stakeholders for this conference, as I mentioned, has been, I think, really successful and important. It's a wonderful 5-way partnership between the various agencies. But I have to say, the honorific of greatest crossover of all time will be awarded to the theme and corresponding title of my remarks today. And I'm going to pick up on some of the themes that Michelle talked about, focusing on transparency and confidence in data in the Treasury market, but try to broaden that to the broader theme of transparency and confidence in financial market data, even outside of the Treasury market. So for those of you who know my proclivity to lace my speeches with music references, no, I promise not to refer to the crossover Taylor Swift and Travis Kelce today at all. You can fact check that. Instead, I'm going to refer, maybe not surprisingly, also to those who know me, to the epic 29th episode of Star Trek: The Next Generation, titled Elementary, Dear Data, which brings 221B Baker Street to the Enterprise in a brilliant Sherlock Holmes-style mystery. Now, it's a perennial fan favorite. I know that Trekkies have strong views on which are the best episodes and which are the best shows, but this is definitely one of the great ones. But the reason I mention today is I'd like to speak about data. How data, transactions-based, transparent, and well-documented data are elementary to our collective understanding and decision-making at the Federal Reserve, and beyond. Before I get any deeper, and rest assured I will, I need to give the Standard Fed disclaimer that the views I express are my own and not necessarily theirs shared by the FOMC or others in the Federal Reserve System. I feel like that must be like the 10,000th time I've said that sentence. Sherlock Holmes stressed the importance of data, data, data. And I, too, and many of my colleagues have been quoted emphasizing the need to be data dependent. In Sherlock Holmes' world, data means fingerprints and footprints, handwriting and ciphers. In our world, data means economic indicators like gross domestic product, the consumer price index, and the unemployment rate. These numbers make up the dashboard of what's happening in our economy. And these are numbers we can trust. Government agencies in the United States and abroad put an enormous amount of effort into developing the methodology, implementation, and design and collection of these official statistics. While no specific data series is without its limitations, we have an excellent understanding of how these numbers come together and how they behave over time. Now, financial markets have their own data dashboards as well. Equity indices, bond yields, the value of the dollar are just a few aspects of understanding what's going on in the markets. And policymakers like me aren't the only ones who are data dependent. Businesses, households, journalists, and so many others rely on data to support their understanding of the world around them. So to be clear, having access to an abundance of data is a wonderful problem to have. Think about the plethora of data you can pull from a terminal and the endless ways you can use it. Many of us, obviously including myself, have spent countless hours, more than we'd like to admit, plotting, running regressions on data. That's what we do. And while we assume that most data are good, there are, unfortunately, bad data, too. The very same terminal that gives you access to numbers that are supported by millions of transactions could also give you access to numbers who have not seen a transaction in quite some time, if ever. And it can be very hard, too hard, I would argue, to spot the difference. This is dangerous. I'll echo the warning of our detective friend Sherlock Holmes. It's a capital mistake to theorize before one has data. And I'll go a step further and say that it's a capital mistake to theorize before one fully understands the origins of the data one has downloaded. So, not surprisingly, I'm going to emphasize the prime example of a capital mistake of this nature, which is LIBOR. Now, by the way, LIBOR officially ended 139 days ago. Not that I'm still counting. But I say good riddance. Okay, so I had to slip one musical reference into the speech because otherwise people will be disappointed. The lesson of LIBOR is that there are times when what we think of as reliable, strong financial market data is really only a mirage. LIBOR is one of the most widely used benchmarks in the world, underpinning hundreds of trillions of dollars, that's trillions with a T, of financial instruments and contracts. And we all know how that ended. LIBOR is inherently fragile and subject to manipulation. And in fact, it's astonishing to think about the entire global financial system relying on a small set of transactions underlying LIBOR. And of course, in times of stress, there were no transactions underlying LIBOR, which opened the door to fraud and bad behavior that we now associate with LIBOR. So LIBOR should be a wake-up call to all of us. It led to the collective realization that things we think of as data may be merely smoke and mirrors. And that's why the Federal Reserve, the Financial Stability Board, and many others have invested heavily in the transition off of LIBOR and onto robust reference rates like the Secured Overnight Financing Rate, SOFR, that are accurate, carefully constructed, and transparent. Now, as we move forward in the post-LIBOR era, it's important that we continue to prioritize transparency and clarity in data, especially financial market data. This is particularly true in the age of AI, when the sources of data are harder to trace. So in addition to SOFR, what do good data look like? How can we, as Captain Picard would say, make it so? To start, I point to the principles for financial benchmarks set by IOSCO, which established a very stringent and specific model for reference rates. And as an administrator and producer of reference rate, the New York Fed is committed to producing rates aligned with this gold standard. Other examples include our regular market surveys. Questions for both the Survey of Primary Dealers and the Survey of Market Participants are readily available on our website, as are the respondents and aggregated responses. Our Survey of Consumer Expectations similarly follows a demanding standard. If data are worth using, it's absolutely worth the effort to make sure people know what they're getting. So we have also increased transparency with the Trade Reporting and Compliance Engine, or TRACE data. This initiative, which was started in 2017 to fill in the gaps of Treasury transaction data, is a significant component of a broader interagency effort to enhance understanding and transparency of the Treasury securities market. This has proven valuable as it's allowed the official sector to closely track developments in the cash Treasury market, and currently underway are efforts to further increase the transparency of this data to the public, including plans to share transaction data on the run nominal coupon securities, as Michelle mentioned. Efforts like these are important because increased transparency and clarity around data leads to better decision making, it leads to better confidence in financial markets. I can't make bricks without clay, Holmes said in The Adventures of the Copper Beeches. He understood that he first needed to compile the facts before building out the case. I argued a similar point back in 2021 about LIBOR. If you try to build on a foundation that is not absolutely sound, you're risking trouble at some point in the future. Unfortunately, and this is where I'd like to broaden the discussion beyond just the Treasury market, this issue is frequently underappreciated by many users of financial market data, as transparency and information on the sources of data are unfortunately often scant. So I'm going to use my favorite example of inflation options to illustrate this broader point. During the recent bout of high inflation, some journalists, researchers, and analysts trumpeted the market's estimate of the probability of certain high inflation outcomes using what they would call data on the prices of inflation options. So these so-called prices or easily downloaded from various data platforms. But here's the catch. Based on our market contacts and public reporting of derivatives transactions, these aren't data at all. There have been no trades reported in the U.S. inflation options market since early 2021, when inflation took off. The so-called data that people are citing are generated by a model and not from investors putting real money on the line, as is frequently claimed. The situation is similar in Europe. Although there are scattered trades in the euro area and UK inflation options, market contacts tell us that the liquidity in that market is extraordinarily thin, and most of what little activity there is in this market is related to complex financial markets and the risk of deflation and not hedging high inflation. And I think there are many, many other examples we can think of with financial market data that the closer you study it and understand what are the underlying transactions, you realize that there's really very few transactions under that. And I think it is an important part of what I've learned of being at the New York Fed and my experience even before coming here is the expertise that we have in our institutions are really invaluable sources of information on these sets of issues. It's like, oh, I learned about some of these only by talking to some of my colleagues here at the bank. More broadly, there's an opportunity for central banks, governments, and the private sector to come together to improve data transparency and accuracy. It takes a global village, regulatory groups, industry groups, and the global standard setters like IOSCO all have a role to play in this. We must use forums and collaborations like these to think through the opportunities to further develop data transparency and make improvements. One benefit of this conference is a partnership it has fostered over the years. Participants have accomplished so much by working together, and given our collective reliance on data, this must be continue to be a priority going forward. It's important to acknowledge that increasing transparency in some cases may face challenges. But that's not a reason to hinder our work in this space. Past experience has shown that there are solutions to allow for greater transparency and confidence in data without distorting or undermining the markets themselves. So I hope you took two things away from my remarks today. The first is you should be inspired to dust off your old DVDs of Star Trek and rewatch those, well worth doing. The second is to heed my call to action. We need to really work together and increase data transparency and understanding so that everyone can have greater market confidence and all of us make better decisions. It's elementary, my dear colleagues. Thank you.
Thank you, President Williams. At this time, we're going to jump right into our first panel, which will focus on the non-centrally cleared bilateral repo market. We will reserve some time at the end of this panel for Q&A. You can go ahead and come up while I'm introducing here. I'll be handing the discussion over to David Bowman in just a moment, who will be moderating the panel. David is a Senior Associate Director at the Board of Governors of the Federal Reserve System. He previously served as a special advisor to then Governor Powell, who working with him on many issues related to Treasury markets. And he was also the board's senior staff liaison to the Alternative Reference Rates Committee. Please join me in welcoming David and the other panelists.
All right, thank you. I'm pleased to say I won't be talking about LIBOR today, but we'll be talking about the non-centrally cleared bilateral repo market, or otherwise coming to be known as the NCCBR segment of the repo market. This is the largest segment of Treasury repo, but it's also the segment for which we have the least data and direct evidence on trading practices, risk management, and the types of participants that are in this market. So with me today are exactly the right set of people to help shed some light on the NCCBR segment of the repo market. So we'll be looking at its practices and contrasting it with centrally cleared bilateral repo, leveraging the Office of Financial Research's recent pilot study collecting data on this segment from the largest participants in it, and also the Treasury Market participants groups work on the repo market. So we'll go in alphabetical order here. So with me today are Mark Barnett, who is a founding partner of Capula Investment Management and Capula Investment US. Mark is currently focused on strategic and financing initiatives, but has had many roles, including Chief Risk Officer, Co-President, and Head of Treasury. Richard Chambers is the global head of repo trading and global head of the short macro trading joint venture at Goldman Sachs. He's also a member of the Treasury Market Practices Group and co-chairs the TMPG's working group on bilateral repo. Chris Clark is head of North American sovereign financing trading within the fixed income financing business at JP Morgan Securities. He manages a team that is responsible for market making, inventory, and risk management for the Treasury Repo Market. Mark Padrick is an associate director at the Office of Financial Research and a co-author of the report on the OFR's recent pilot study of the NCCBR repo market. His research is focused on market microstructure, central clearing, financial intermediaries, and stress testing. And finally, last but by no means least, Jim Tabaki is the president and CEO of South Street Securities Holdings, one of the largest independent repo dealers, which he founded in the year 2000. Jim is chairman of the board of the Independent Dealer and Trader Association and is also a member of Bank of New York Mellon's GSS Advisory Council and DTCC's Board of Directors. So thank you all for being here today, and I look forward to the conversation. Mark, can you kind of start us off and relay a bit of what you learned in the pilot study?
Sure, happy to. I'm going to give you a quick overview of our study of the US NCCBR market. This is of course, joint work with colleagues from the Federal Reserve Board, and the Office of Financial Research. Now, as David noted, I think there's three components to why we care about NCCBR from the OFR's perspective. One, it's of the four segments of repo, it's the one with the least transparency currently to it. While the other three have currently daily collections, it means that we have less understanding of its usage. Second is we believe it to be the largest, and that's thanks to the Federal Reserve Bank of New York's primary dealer statistics here on the figure on the left. It shows that at roughly $1 trillion of reverse repo and repo activity occur with these dealers alone. And the third, and the most interesting, I think to the broader market, is that this is the repo segment seen to be the one providing funding to the non-bank financial institutions. And so, for example, here, the figure on the right shows hedge fund borrowing activity from statistics from the SEC's private fund statistics. Of the funding that we see here, we can only explain currently 8% of it based off of our current collections, suggesting that the remainder of that is likely occurring in NCCBR. So why is this segment so popular? From outreach in early 2022, we came away with three comments. One of those was access to central cleared market was relatively seen as difficult or costly and time-consuming for some participants. Second, was that there was generally less flexibility in the collateral and tenor or availability in other segments. And finally, the one that's probably received the most attention is that NCCBR is seen as a place that's generally more flexible in its haircuts and margining practices, in part due to the ability to offset repo and reverse repo activity on a bilateral basis, netting down collateral risk and ultimately making it relatively cheaper to keep it uncleared rather than novate it to central clearing. So to test these advantages, the OFR ran a pilot study, as David mentioned, and with 9 pilot participants, which then we were able to match not only from the NCCBR activity to what we currently have collected through daily collections. And the OFR also was used this information to help inform a proposal for a continued collection of NCCBR, which it hopes to make a final rule statement in the first quarter of 2024. So addressing the first advantage, so overall the set of market participants broadly is quite diverse, though the majority are hedge funds that we see from this pilot study. though there are other market participants such as pension funds, sovereign wealth funds, REITs. Now, addressing the first advantage stated here, what we find is that the majority of the participants, at least based on a volume basis, do have currently sponsored membership to the cleared market, suggesting that this is not inherently the major reason that we see so much activity remaining in NCCBR alone. The second is the diversity of collateral and tenor. Well, we certainly do see a diversity of collateral shown in the figure here in the bottom left. The majority of it is U.S. Treasuries, which can be centrally cleared or taken to other segments. Now you might ask, well, is it because they're getting better rates in NCCBR versus the other segments? And the figure here in the center ultimately shows that we see, at least in the cleared segment, relatively identical rates being offered in overnight Treasuries. The third figure here on the right, it does show that tenor, though, does seem to be a factor, or at least broadly as the percentages go, that we see longer tenor repo occurring in NCCBR versus the other segments, suggesting that if you're doing longer term trades or concerned about rate fluctuations or funding concerns, that this might be a better place for you to trade. Finally, is the haircuts. Typically in most other segments, we think of a traditional haircut on, say, U.S. Treasuries at 2%. What we find in bilateral repo, due to netting packages, is we believe that 74% at least of U.S. Treasuries in the pilot study have zero haircuts, and this is due to the offsetting repo activity leading to ultimately what looks like an asset swap up. When we actually look at netting, of course, this is limited to only looking within NCCBR activity. We can explain 46% of the total amount as these netted packages. Doesn't necessarily inherently mean that the remainder is somehow not being offset. It's just that we don't have that visibility inherently. So I'll stop there, as those are the main takeaways of our study.
All right, thank you. That's a great start. So Richard, Chris, and Jim, as dealers, can each of you walk us through how you view this segment of the market and how you use it in comparison to, say, FIC DVP or DVP sponsored, and also how you see your clients or other market participants viewing this market versus centrally cleared, and if you're seeing changes in that over time as we see changes in demographics of who's buying treasuries. Obviously, the Federal Reserve is not buying them now, and we see households, including hedge funds, stepping up and buying more. So are you seeing changes in how people are using this market? We can start with you, Richard.
I'm happy to lead off. Go ahead, Rich.
It's a very important, it's the heartbeat of the Treasury market in terms of the plumbing of our funding systems, that is Treasury Repo. The provision of bilateral repo to our client base stems from all our clients, from central banks all the way to asset managers to hedge funds, not just hedge funds. So leverage in treasuries and access to the repo market and bilateral repo is a hugely important part of markets functioning. When you look at when you look at changes and you look at where we are right now in the repo market, even as we compare it to 2019. The market is more robust versus where it was 2 to 3 years ago. We have, there's a lot more of the lever community signed up to sponsored repo versus, that really not existing in 2019. We also have more participants on the other side of the ledger in bilateral repo, in using repo as a form of deployment. Banks use repo as a form, in terms of sourcing bilateral repo. They also use it as a form of GCLA deployment, and they use the bilateral repo market in their monetization assumptions for their GCLA. I would say in terms of the demographic of buyers of treasuries, holistically we know there is a lot of supply of treasuries coming. Then we expect to go from 27 trillion to potentially 46 trillion in 10 years in treasuries. So it's very important to to have a very robust system, as there will be more demand for leverage in treasuries, as there is more dependency on the private side of the market to buy treasuries in the next 10 years. I would say that as more coupon supply is coming beyond what generally is 1 year in and what money funds are buying, and as we expect more coupon supply into 2024, we would expect demand for leverage from the private side, including hedge funds and real money accounts, to increase, and demand for bilateral repo to increase also.
Okay, thanks. Chris?
Sure, I can add on to that, maybe some more context. The market has grown. The market's going to grow. The CBO expects to double in the next 10 years. By nature, the repo market needs to grow as well. The dealer intermediation capacity is at the heart of that growth, and constraints around that dealer intermediation capacity are really what leads to our decision-making process on whether we're going to trade with a client cleared or uncleared. So because of sponsored repo in today's world, there really can be a very simple but dynamic cost benefit. There's going to be a decision-making process based on the dealer's binding constraints. So very generally for a domestic bank like the one that I work at, we have a variety of binding constraints, and those can change and have changed over time. So balance sheet and other measures of net balance sheet were the problem in 2018 and 2019. Sponsored repo very effectively solved for that problem. So where sponsored repos benefit are you're enjoying the greater benefits of the CCP netting. You can avoid additional GSIB capital on a cross-jurisdictional trade. The cost is there in the form of additional margin to the CCP. Now, 2 years ago, that cost was in and around zero for additional funds that you might need to borrow as a business to post to a CCP, and now we know it's much more expensive. So that simple kind of cost benefit is dynamic, and where in 18 and 19, sponsored repo was a very effective solution to what was then the binding constraint, we now have shifting binding constraints, and we have gross measures of our dealer activity, which cannot be solved through sponsored repo alone. So whether it's RWA capital, GSIB capital, or additional IM, these are all measures of our gross totals. So we'll get into some of that more in terms of netted packages and things like that, but just wanted to lay that kind of additional context in the importance of really the near future and the shifting composition of the 2024 supply, which is going to be just as much as this year. And I think all are relatively relieved at how well the market has absorbed and intermediated the additional supply to start, but we can't assume that that's going to be the same case for the next $2 trillion.
Thank you. Jim?
Sure. First, I should just get out of the way that these thoughts and words are my own and not of South Street Securities, the Dealer Association, or FICC. Sorry, DTC. So I think one of the things we have to look at is one of the questions is why are so many buy-side firms going to the bilateral market rather than the cleared market? And I think there it's from what I understand, it's simply risk diversification, guys. It's you don't want to put all of your eggs in one basket. Now, I will go right up front and say that myself and most of my associations are very much in favor of the clearing mandate that brings most of everything through FICC. But we have to do it correctly. If we do it the way it was originally laid out, you're going to increase the risk in a single point of failure because it will wind up with far more concentration risk amongst the biggest institutions. Look, I think that the sponsored program was a brilliant idea by FICC to create capacity in the U.S. Treasury market. It was really a smart move. However, because the rules for the largest versus the mid-market players, actually the largest and everybody else, are so different, we have started to grow concentration amongst the largest firms. That's what is scaring the bejesus out of some of the buy-side clients. Because if you're now going to have a single point of failure, and that single point of failure is overly concentrated with the largest firms, you are compounding the single point of failure. Just, I've got a playbook just right from this recent week. What if it wasn't ICBC's prime broker that failed? What if it was one of the top 3 prime brokers on the street that were hacked and that all their systems were down? The impact on the marketplace would be enormous. And we have to kind of get our arms around the Treasury market and give it a little hug. It is the largest, the most liquid, and the most important market in the world. We have to be very thoughtful. The clearing mandate can be a good thing. The sponsorship program can be a good thing. But we have to be very well thought out and play the tape down going through a number of different circumstances. This is not an academic exercise where you can do charts and graphs on a model and say this is how it's going to turn out. These are real live markets with people that are executing in them. There's psychology and there's fear when things like what happened this recent week happened. So it's not academic. We need to take our time. And the other thing I will say is everybody's talking about the lack of haircuts in the bilateral market. Well, if you're going through the sponsored market, the largest banks are picking up the tab for the haircut. And what we need is standardized, very simple, straightforward rules on both sides of this fence, regardless of whether everything gets cleared or not cleared. You need standardized haircuts.
Okay, maybe we can stop there.
I'm sorry.
That's all right. It's my job to keep us on time.
Yes,
It's your job to say interesting things. Mark Burnett, as a prominent end user in this space, how does a relative value hedge fund look at these two markets? Is Capula active in both bilaterally and centrally cleared repo?
So yes, Capula is very active in both sides of the equation in terms of NCCBR repo as well as centrally cleared repo or sponsored repo. I would say over the past, Capula was one of the early adopters of sponsored repo. We saw the advantages, and as such, over the past 5 years, have spent the time and effort to develop the operational infrastructure, the legal agreements necessary to engage in sponsored repo with many of the sponsored repo providers on the street. I would say the decision to trade one versus the other is a discussion. It's a mutual decision at time of trading. In some instances, we may have a preference to keep the trade bilateral. Capula looks at repo as part of the firm-wide risk management, kind of counterparty exposure management. And if there is a case where the bilateral repo will offset existing counterparty exposure, we would have a preference to keep it bilaterally in order to mitigate that. I guess conversely, the dealers, as mentioned at time of trading, will, number one, some dealers, don't support sponsored access. So immediately, because there's no concept of given, you're unable to trade sponsored repo, and it would have to be bilateral. But for those that are offering sponsored repo, it's a cost-benefit analysis from kind of the provider at that time of trading, and they have their preference. I would say, to Chris's comments, over time we've seen changes in terms of the preference of sponsored versus bilateral, again, over time or relative to where kind of base rates are in the cycle.
Yeah. So is it sort of a day-to-day decision? You look at your constraints and you decide how much you need to do in sponsored if certain clients come and how much not, or?
Well, I think that banks are constrained obviously by different, whether it's SLR, balance sheet, RWAs, capital. I think that just to briefly explain, every agreement across different banks are bespoke. Yeah. So there's no, as Jim said, there's no standardization, so to speak. I think when you look at this, the participation in sponsored, it's roughly from the reverse repo side, it's leveling out at roughly a 300 billion steady state for the last 3 to 4 months. When we make our decision, when we make our decision whether to go sponsored or to go bilateral, and the decision on and a decision on credit counterparty risk, it's multifactored. We look at the terms of our MRA. We look at what netting agreements we have with the individual client in other businesses. And the bottom line is, we look at the concentration risk of the underlying trade. We also, in the event of, we look at also the term of the trade and also the duration of the collateral. One other important point is if you do a term bilateral trade and a haircut is decided at inception, whether it's 0 or whether it's 2%, versus when you trade in term sponsored, that IM can change over the time and the lifetime of the trade. Yeah. So oftentimes there are preferences from the client base to have a fixed and known haircut for the period of the trade.
Okay, so it's not just day to day, it's client by client and
Correct.
maybe minute to minute. Let's move on then. We heard from the OFR study that a number of these trades do, at least on paper, have 0 margins. Is what Mark Padrick described finding in terms of margins and netting, is that consistent for the dealers here with your own experiences? And how do you risk manage trades with 0 margins? How do you deal with your overall risk management here? So maybe Chris, we can start.
Yeah, I can jump on that. And Mark had mentioned one of the key features of the NCCBR is a flexible, margining arrangement, as opposed to a uniform one in the CCP. So certainly over time, competitive forces can and have driven haircuts down. We see that they've driven them all the way down to 0. So ultimately, what does that mean in terms of, from my perspective, a dealer, what does that mean in terms of my costs as well as my risks? So, where Mark's and the OFR's study pointed out a large portion of these exposures at a 0% haircut were done in netted trades, that's not to say that those are without risk. Certainly the most true relative value trades where you're swapping bonds within the same duration bucket that have the same price sensitivities, there's not much of any risk there. The reality is a lot of these netted trades will get done with varying durations, depending or in between what the dealer is taking and receiving. And I think the point needs to be made on the netted trades. The benefit is that it takes it off the balance sheet. And that was, I don't want to say yesterday's problem, but our foremost concern is capital and these gross measures of the balance sheet. So although a netted package is great and it's off the balance sheet, we would presumably need to hold the full RWA capital against both sides or both legs of that trade if done at a 0% haircut. So there's a concept of just clearing the cost of capital and whether the trade is netted, whether it's directional in the bilat market, whether it's directional in the sponsored repo market. There really just comes down to this simple cost benefit. What do we need to clear it? Now, do we clear it on every trade? Maybe, maybe not. But ultimately, in sum, we are doing and meeting our client demands in all segments of the repo market and using our decision-making power in a sense that, that not every trade is dealer's choice. But if we assume Treasury's only 0% haircut, same price to the end user, they should be indifferent and it should be dealer's choice in terms of how and where they direct that trade. So ultimately, a uniform margining regime would change that. and increase the cost of that trade by introducing the additional CCP margin, which to date, we kind of view as a cost of doing business and running our match book with our client base.
Okay, Jim?
Sure. All good thoughts. What I would say is that I'm personally not a big fan of zero haircuts. The firms that I'm involved with are members of the sponsorship program, but don't do a lot of sponsorship for the simple reason that it's almost a race to the bottom. Zero haircuts, 1% and 2% spreads, and your credit underwriting everything. And it is competitive pressure that's driving that. And I don't think that's healthy for the marketplace. So that's another reason why that we do a lot of bilateral, the firms that I'm associated with. I don't know why. Look, the big banks have an opportunity to use their own capital to support the sponsorship program and not charge their clients haircuts. And that is a competitive advantage, which is driving concentration risk to the larger banks. Now, I worked at a big bank, Citibank, for 20 years, arguably at that time the best bank in the world. I understand what's the decision-making that's going on there. And if I was still there, I'd probably still be doing the exact same thing. Having gone to the mid-market dealer side and understand the ramifications there, and watching the market evolve to being more and more concentrated, I'm saying, from a market perspective, this isn't good. We don't need fewer, larger players. We need a lot more smaller, mid-market players. Why would we not want to encourage private capital coming into the marketplace to affect more liquidity flows in U.S. Treasury and Treasury repo? We need more diversification, not less. So that's why this mandate has an opportunity to do that if we do it correctly.
Okay, thank you.
David, just one point on, as Jim says, large banks. I think it's important to note that different banks are regulated by different entities. So U.S., like as Chris said, gross to net, or netted packages, not only are gross for RWA, they're also gross for short-term wholesale funding and GSIB. European banks have different regulatory constraints and are maybe less sensitive to RWA metrics, and Canadian banks may have different capital constraints. So that can give competitive advantages in that market. I think one point to make is that, just even hearing the comments here, there's a definitive want and need for some sort of guidance in terms of standardization on haircuts.
Okay, thanks. Mark, you're on the other side of this, Mark Burnett. How do you how are the margining decisions, that are offered to you or that you negotiate for? How do you see them, and how do you see it as part of your overall risk management for the firm?
So I guess it's a complicated answer. I mean, the margining paradigms or margining frameworks are very much dependent upon the counterparty we trade with or we clear our transactions with. In terms of risk management, our preferred is actually some sort of cross-product margining or portfolio margining, whereby the trades are aggregated together and some sort of VAR and or stressed margin is calculated on that portfolio, and there's some degree of offsets for kind of long and short positions or netted positions. As a relative value hedge fund, that's very effective and very efficient, representative of the risks that we are running. But I would also add the counterparties in these cross-product margining arrangements actually do two calculations. They do a calculation of the portfolio margin, which is called the house margin in colloquial term, and they do a calculation of the clearinghouse margin of the cleared components in that portfolio. And the paradigm is that they charge the higher of the two. So in a lot of instances, especially because we're relative value, the house margin is much lower than the clearinghouse margin, the reg margin. So we're posting the reg margin. And I guess to give you an example, we look at a simple kind of 5-year basis trade where you basically go long the 5-year Treasury CTD against shorting a position, an interest rate neutral position in the 5-year Treasury future. Typical counterparty cross-product margin arrangements will margin that trade in about 100 million notional, or margin that trade about 50 to 60 basis points of notional. When you look at just the cleared component or the reg margin, which we're required to post, you're looking at 130 to 140 basis points. So, and we're posting that amount, almost double what the counterparty is calculating as the margin required to support that trade. The counterparty then uses that posted margin to support both sides of the transaction. In the event of a default, our default, they would be able to use that money posted to kind of liquidate the trade and recover any costs. So, to say there's a large majority of 0% haircuts, I think is a little bit misconstrued in that while explicitly on the Treasury there is no haircut, in a combined portfolio, given that we are providing excess margin on the cleared future side or the portfolio side, the dealer is able to kind of offset and utilize that margin and cover themselves.
Okay, that's super helpful.
Can I just make
Quickly.
one comment? Mark makes a really good point. Mark is a good friend of mine for a lot of years. We've had a lot of discussions on this. And the one thing that concerns me about in portfolio margining is, in the most likely event that a very large hedge fund buy-side firm fails that is being portfolio margined, they're probably not going to fail because of their U.S. Treasury position. They're failing for something else in their portfolio. But the problem is, if they're a big Treasury player, they will cause a significant disruption in the Treasury market. So I agree with Mark that, portfolio margining, he's actually paying a haircut. It's not really zero. But that haircut should be proportioned in a very simple fashion across all of his products. I like simple rules. If you notice in the marketplace, the simplest rules seem to work better for a lot of years. So if you just have standardized haircuts across all products and you proportion those haircuts appropriately, you'd have the benefits of portfolio margining, but you'd also have haircuts against everything. I think that strengthens the U.S. Treasury market, and I think it strengthens the others too.
Okay. So it is still my job to keep us on time. So we're going to roll through the next question. Jim, you've already kind of touched on this, which is, if these trades went from NCCBR to centrally cleared, obviously they would be subject to a uniform margining regime, still on a net portfolio basis of the trades, that FIC has, of the portfolio cleared at FIC. But it's my understanding that, and I want to check this with you, that's still market practice that in those sponsored trades, say with a hedge fund, the dealer will post the margin to FIC out of their own funds, not out of the client funds. So, Richard and Chris, is that what you tend to see in the market?
It tends to be a common market practice. I would say that the current model itself, and to be clear, there's no silver bullet to fix this. There's trade-offs as we move to centrally cleared. But in the current sponsored model, it still doesn't solve the RWA constraints that banks have, and it currently, it doesn't necessarily solve the pricing of leverage, i.e. the pricing of credit counterparty risk in the system. So the current sponsored model right now, and it's based on bilateral negotiations, doesn't necessarily reduce credit counterparty risk in the system or the pricing of leverage.
Thanks. Chris?
Sure. Where the repo market hasn't shown any signs of disruption, facilitating whatever turns of leverage exist today, it may not be the case in the future. So where we've all been talking about capacity and where that might be limited, we haven't seen it yet. But this as an example, the dealer paying the customer's IM at the CCP, is an example of a recent increased cost and something that can be covered maybe through rate, it may be just paid for by the dealer in the name of a good relationship. But ultimately, there's a break point there in terms of who or how is the market going to pay for the haircut? Who's going to pay for it? How is it going to fall? It could be an explicit minimum haircut structure, but more likely it's going to fall to bilateral relationships like ours with end users in an effort to cover these costs. So kind of a market in total coming together and solving for what the regulators want and is a market haircut in a sense.
Okay, thank you. So we have roughly 10 minutes, and we got 2 more questions. So Mark Barnett mentioned the magic word of basis trade, which is a pretty hot topic right now, and with some reports noting that it appears like the volume of basis trading has increased over time and seems close to what you saw in late 2018, 2019. So I want to go through each of the group and ask, in your opinion, is the nature of basis trading and volumes, are we similar to where we were in 2018, 2019, or do you see it as different? We can start with you.
I would say I see it as different. In particular, and just cognizant of time, there's obviously dislocation in the market, and that's supply-demand dynamics. Participants have an interest in buying Treasury futures with no natural supply of sellers, and the overwhelming issuance from the U.S. Treasury perspective is putting a burden on a market that has historic players kind of pull back. So, the basis trade is there. Hedge funds or private funds are taking constructing trades around that basis trade, ultimately providing liquidity in the future and also providing liquidity in the bond space. Arguably, the private funds are providing a linkage between the U.S. Treasury bond and Treasury future, and arguably kind of reducing the cost of the borrowing from the U.S. Treasury perspective. Now, I would say it's definitively different in 2019 to 2020 because, more specifically in Capula's case, we do look at scenario loss limits, and March 2020 is definitively in our kind of risk management structure. That is a specific binding constraint that is limiting the amount of basis leverage and limiting the amount of U.S. Treasuries that we are purchasing relative to what we could have or would have been doing in 2019.
Great.
I think when you compare the current market structure right now versus events like September 2019, March 2020, and market positioning, I think the market is less levered at a starting point of now. I think you can see that we sold off 70 basis points. We'd significant stress in the overall Treasury market as we priced in more term premium from July to October, and what you would deem as consensus relative value trades in the Treasury market performed very, very well. So that's a good indicator of positioning. And also, I would say, across our franchise data as well. But it is going to change. Like, we have this supply coming, and it's super important to have certainty in terms of what the cost of Treasury leverage will be on a go forward. If I suppose, put another way, and there's expectations of an announcement with regards to whether it's centrally cleared or we go minimum haircut, I think nothing is worse for the market than uncertainty. So it would be good to get guidance as the supply comes. So currently, I don't see positioning as concentrated as previous events, but positioning will increase into 2024.
Thanks. Chris?
Yeah, I think within the context of the market growth, that positioning seems reasonable. The dramatic growth from the pandemic in the Treasury market has presented this opportunity where hedge funds do provide liquidity in the cash market. Their relationships with the repo providers then complete the trade. But I think this is just a great example and what we can think about in terms of going into 2024. A declining liquidity environment, ongoing QT, to the extent that there's a repricing to happen in regards to the market haircut. That might present an opportunity, but where the pricing on this new, the new supply or leverage on the new supply comes might just not be at the same as last year or something like that, said very generally, or each trade is different than the next. So just a great example and something that will highlight all the capacity things that we've been talking about, and to the extent that the market is able to do it, it is, just to Mark's point, beneficial to overall liquidity, where the hedge funds are providing liquidity in the cash base and are able to finance it in repo.
Okay, and Jim.
Yeah, I'll just wrap this up. Look, I think the hedge fund is the community that's growing. Our treasuries are growing. Foreign central banks are buying less. So again, I think we have to embrace the hedge fund community, and have to try to work together with them to help them. In terms of when you look at the amount of treasuries that we have to print over the next 10 years, I personally don't believe that regulating the hedge fund industry makes a lot of sense, because usually what happens when regulation comes in, immediately creative initiative starts to get squashed by bureaucracy. I think we can do a better job if we regulate how we clear. And again, I'll come back, standardized haircuts. CCLF, that does not work at all. FICC, Laura Klimpel has a great idea about how to solve that problem. FICC has been out with outreach in terms of trying to help everybody adapt to the mandate. There's a lot of great ideas out there, and I think if we just walk through it in a very thoughtful process, we can do a lot of good things. But the way we're going now, if you think about the Treasury issuance going up for the next 10 years, I think it's a crash course. You're going to see more and more participants leave the marketplace because they can't make a living. And the simple reaction of, reduce capital requirements and we'll have plenty of capacity. Well, guys, we've tried that before, and it didn't work too well in the long run either. So I think we have to really think through this. We need more capacity from more institutions coming into the market and putting private capital to work to create more liquidity flows in the Treasury market.
Okay. So last question from me. We're going to do 5 minutes so we can have some questions from the audience. So, you've all reported that you can and do move between centrally cleared and bilateral in repo. So how do you think about, how market dynamics might change, or would they change if centrally cleared repo increased, either voluntarily, just people began to move that way, or through, potential rulemaking? How do you think about what dynamics might change? Yeah.
Yeah, so I guess, obviously, mandatory central clearing would be a kind of radical change in the market. I see kind of increased cost of trading and kind of increased margins at the initial. I do have a concern kind of over the medium term in that, currently, I guess the FICC and the CME are working on have a kind of offset margin solution in place. Currently, that's only relevant for the banks or I guess basically clearing firms that are direct members of both the FICC and CME. But as I understand it, number one, there has been approval given for an enhanced margining paradigm, which allows for greater efficiency and more offsets and more kind of instruments in the basket. But number two, it's possible or it's been looked at that potentially could be extended to all sponsored member participants. My concern there is then that'll drastically reduce the amount of initial margins for participants that are both clearing futures and clearing repo to a level far below what we're currently concerned about today. To the point of kind of minimum haircuts, if that were to come into fruition, I do strongly believe that some level of haircut or minimum amount should be calculated, such that in periods of normal time, it's amply sufficient that when market volatility increases, when periods of market stress, there's not the need for additional margin calls. I think that's important because that provides a circuit breaker, a stop to the kind of pro-cyclical margin methodologies that are currently in play today, and ultimately amplify the deleveraging process and provide further volatility to the market.
Super helpful.
Yeah, I think a minimum haircut gives the market a robustness and a good starting point. I think we saw incidents in the UK gilt market in October 2022 where the starting point was not strong, and it created more systemic risk. I think if we go to, I think a total centrally cleared model, while it has its benefits in terms of overall oversight, in terms of, and data transparency, and netting efficiencies as well in settlements, it will increase the default fund. So as we said, it will increase the cost of trading. It will create barriers to enter the Treasury market, because simply there will be clients who will not centrally clear, not in the hedge fund space, but there's a huge amount of clients outside of the hedge fund space who trade Treasury repo and buy Treasuries. And finally, I think Jim pointed out, if there is a default event, it will cause bigger reverberations in the market as opposed to isolated ones if a default event of an entity was on a bilateral basis. So that would be the major kind of structural changes if we went to centrally cleared.
Chris?
Sure. More central clearing is going to increase costs and should, by nature, necessitate a widening of the bid offer in kind of match books across the street. For all the reasons that we've talked about, this additional IM cost, whether the dealer is going to pay for it or if it's borne mutually, is just another example of an increased cost. And in order to keep match books at the size that they are, presumably some widening in the bid offer would need to happen to facilitate the additional growth. This could have an impact certainly on the cash market, but one of kind of the foremost things, I keep saying, in my mind, and certainly all the benefits of central clearing, which was one of the highlights of last year's conference, are all well known. But for an immediate impact in the repo market, I would say a wider bid offer.
Thank you, Jim. You've already shared some of your thoughts.
I'll just wrap it up this way. I'll promise to be quick. The one thing that we didn't touch on, I think there's an infrastructure cost to this as well, which I don't think anybody can easily dismiss. But at the end of the day, a little bit more cost and a little bit more haircut to maintain the viability and the safety and soundness of the U.S. Treasury market, I think is something that we all have to bite off and just do, because it's too important not to do it.
Well, thank you. We do have time for one or two audience questions, I believe. Oh, we have one from Aga.
Hi, Aga Mirza from CME. Just a question for Chris Clark. Chris, I think in your earlier remarks you mentioned that the evolving nature of sort of your balance sheet and the binding constraints are such that the current sponsored access repo arrangement doesn't provide the necessary netting. So with regards to that, with respect to the binding constraints experienced in this environment, what is the economic incentive for use of sponsored repo other than safety and soundness?
Sure. Just to make that clear, in sponsored repo, we're going to enjoy the benefit of netting or potential netting of that trade, in addition to a capital save on a potential GSIB charge if that was a cross-jurisdictional client. So there are many benefits to trading in sponsored repo. The rub is just the additional IM cost, and that happens to be a varying percentage cost based on the duration of the bonds that you're pledging in. So, where net balance sheet really isn't a binding or the binding constraint today, it has been in the past. The point there was it was more of the gross measures where to solve for net balance sheet, you could do more in sponsored repo. Gross measures of your balance sheet really necessitate doing less, or in some instances, pricing accordingly just to cover your cost.
Right. Is there another question? We do have time probably for one more. Yep.
Hi, Scott Skirm from Curvature Securities. Now, I've read, most of the information out there on the Treasury clearing proposal, and most of what you read, it sounds like it's the next great thing, for reducing risk in the marketplace. Most of the market participants, people, banks, people that are actually in the market, talk about the increase in costs associated with the Treasury, with the SEC Treasury clearing proposal. Why does it matter? Like, if costs are going to increase in the marketplace and bid-offer spreads widen, we talk about that as market participants, but what does that mean for the Treasury, for the U.S. government, for buyers of U.S. Treasuries? How does that affect them?
I think high level. I think it will increase the natural level of yield of Treasuries. I think in the decision-making process to put on whether it's a relative value strategy or to put on a strategy involving the Treasury, and you are dependent on leverage as a part of that trade, your hurdle to entry is higher because your costs of leverage are higher. So I think the net effect is it leads to slightly higher levels of yield, and I think the barriers to entry from a cost function of leverage are higher. But the flip side on that is it obviously increased robustness in the overall product and probably reduces tail events.
Yeah, maybe just the risk in the period of transfer. And, ultimately, the cost of the taxpayer may go up. But Scott, we really shouldn't care that much, other than if the process itself is disruptive to market liquidity or resiliency. When the process is done, the haircut is paid for, presumably we should be left with a more resilient marketplace. And over time, hopefully a lower cost of the taxpayer and alike.
Okay. Well, I could spend all day talking to you all about this market, but we've filled our 55 minutes. I really want to thank all of you. Thank you.
Good job.
Open the bar.
Thank you to David and the panelists for that great discussion. We're now going to move on to our next set of keynote remarks from Michael Barr, Vice Chair for Supervision at the Federal Reserve Board of Governors. Mr. Barr took office as the Vice Chair for Supervision in July of 2022. He also serves as a member of the Board of Governors and on the Federal Open Market Committee. Prior to his appointment at the board, Mr. Barr was the Dean of the Ford School of Public Policy and the founder and faculty director of the University of Michigan's Center on Finance, Law, and Policy. He served as the Department of Treasury's Assistant Secretary for Financial Institutions from 2009 to 2010, and also served at Treasury in the Clinton administration. Please join me in welcoming Vice Chair Barr.
Thanks very much, Brian, and thank you all for being here today. I will say the usual disclaimer that my remarks are my own and not necessarily those of my colleagues on the board or the FOMC. I'm pleased to join you today at the 9th Annual U.S. Treasury Markets Conference. This event is a joint effort by the agencies that make up the Interagency Working Group on Treasury Market Surveillance and serves as a reflection of the group's ongoing crucial collaboration. The flash rally in the Treasury market in October 2014 revealed a need for a deeper understanding of Treasury market functioning. The report that the joint agencies produced in response sheds light on how the market had evolved. Since then, this annual conference has provided a forum for the official sector to come together with market participants and the scholarly community to identify ways to bolster the resilience of the Treasury market. This coordination has been important as we have worked together to study subsequent bouts of market stress. I am proud of the work done by the staff of the agencies and the private sector participants, and wholeheartedly support our continued collaboration to advance work in this area. Before I dive into my remarks, I want to thank the Federal Reserve Bank of New York for hosting this event once again, and for its ongoing thought leadership on Treasury market functioning. I also want to acknowledge the important leadership of the U.S. Department of the Treasury in convening both the agencies and the private sector to analyze longer-term issues and to address emergent issues. Let me start by sharing a few thoughts on why I think work on Treasury market structure is so important to the public and to the Federal Reserve. First, Treasury securities are the primary means of U.S. federal government financing. The American people rely on the Treasury market to function well so that the Treasury can issue debt efficiently. Second, the market for Treasury securities underpins the pricing of assets across the financial system, providing benchmark rates on which other assets are priced. As such, the Treasury market is a key component of the transmission of monetary policy for the Federal Reserve. In addition, open market operations in the Treasury cash and repo markets have long been central to how the Fed implements monetary policy. The Treasury market also helps us to understand investors' views on the outlook for growth and inflation. The insights we gain from studying the evolution of Treasury yields across the curve helps us understand financial conditions that affect borrowing costs for businesses and households. Finally, Treasury securities serve as reserve assets for private savers, financial institutions, and other countries. For example, Treasuries comprise a significant portion of banks' high-quality liquid assets. In times of stress, certain sources of funding can, in some cases, exit quickly. In such cases, access to immediately available liquidity is important, and thus, even in normal circumstances, helps promote safety and soundness. This means that markets for high-quality liquid assets need to be deep and well-functioning in a variety of conditions. Of course, these holdings cannot completely insulate banks from acute risks, a point I will discuss later. But having a readily available liquidity buffer to meet outflows can provide firms with some flexibility to adjust their balance sheets in response to changing market or firm conditions. The events in March of this year made it clear how important it is for banks to properly manage their interest rate risk. So I want to spend a few minutes on this topic. To start, I would say that years of very low interest rates led to complacency at some financial institutions about the degree to which banks needed to manage interest rate risk, including in high-quality liquid asset portfolios. As in the case of Silicon Valley Bank, supervisors also could have done more to forcefully act when they identified problems. Savings soared during the pandemic as normal spending was disrupted, and government payments to households and businesses increased significantly to avert a massive economic contraction. As a result, bank deposits grew rapidly. To manage balance sheet growth, a number of banks invested in securities, including Treasury securities, but investing heavily in fixed-rate, long-duration assets without appropriate interest rate risk management led to problems in some cases. As described in our Financial Stability Report, as the FOMC raised the policy rate to combat inflation, yields increased across the curve, and some banks experienced sizable declines in the fair value of some of these assets. The higher rate environment also affected the liability side of bank balance sheets. The outflow of bank deposits into money market funds and other alternative short-term instruments, for the most part, has been and remains both anticipated and orderly. Unfortunately, a few firms had a combination of both poor interest rate risk management and weak liquidity risk management. The combination led to failure, as staff documented in my report on Silicon Valley Bank. The contagion from the failure of Silicon Valley Bank, Signature Bank, and eventually First Republic was stemmed from spreading further in large part by the invocation of the systemic risk exception, permitting the FDIC to fully pay out on uninsured depositor claims, and the establishment of the Bank Term Funding Program, which provides a long-term source of liquidity secured by treasuries and agency securities at par. Deposit flows have reverted to their normal patterns. A few observations are in order, however. I will start with the liability side of bank balance sheets. As I mentioned, as yields on deposit alternatives, such as money funds, increased with our tightening cycle, as our tightening cycle took hold, banks found they needed to start paying higher interest rates to retain deposits and pay up for alternative sources of funding as they lost deposits. A recent paper by 3 members of the Federal Reserve staff discusses how deposit betas rise in a dynamic way as interest rates rise, rather than having a static relationship to rising rates. This paper formalizes the intuition that banks must be prepared for potential declines in deposit duration as rates rise. Looking at the asset side of bank balance sheets, most banks do not need to record unrealized gains and losses of their security portfolios in regulatory capital. Banks have an incentive to avoid selling hold-to-maturity securities because selling even a portion of the portfolio taints the entire portfolio, since it requires recognizing changes in value. But even if not recognized from an accounting or capital standpoint, losses on long-duration asset portfolios can still lead to challenges. Federal Reserve supervisors have stepped up their supervision of interest rate and liquidity risk, given what we have learned from recent experience, and they will continue to work with banks to ensure their balance sheets are resilient to a variety of conditions. That brings me to the importance of contingency funding, planning, and preparation. Banks don't need to sell securities to gain liquidity value from them if they can borrow against them. But firms can face challenges in significantly ramping up funding in private markets, such as repo markets, particularly if they do not tap those markets regularly. In July, the board, along with other relevant agencies, updated guidance to highlight that banks should maintain a broad range of funding sources, including the discount window, which can be accessed in a range of circumstances. Liquidity sources that are not regularly tapped or tested may not function as expected when most needed. I have recently discussed the importance of discount window preparedness. Last month, I outlined how the discount window is an important tool of both monetary policy and financial stability. It is an important tool of monetary policy because, with the primary credit rate set at the top of the target range, it supports rate control. It is also an important tool of financial stability because it provides ready access to liquidity, regardless of market conditions. Other sources of funds to banks, even the federal home loan banks, are dependent on a functioning private sector market to provide liquidity to their customers. When the market is not working, such sources of funding and liquidity can come under strain. The discount window, however, can play these important roles only if eligible institutions are both willing and ready to use it. This means that it is important that banks establish borrowing arrangements, pre-pledge collateral, and engage in test transactions at regular intervals. I also want to highlight the Standing Repo Facility, or SRF. The SRF was established by the FOMC to help keep the federal funds rate within the target range if pressures arise in short-term funding markets, with the rate currently set at the top of the target range. This facility can be useful to both primary dealers and banks because it gives them another venue to raise liquidity against Treasury securities and other eligible securities. It is encouraging to see an uptick in interest among banks to join the SRF as counterparties, with 10 more banks onboarded as counterparties in the last year, bringing total coverage to about half the assets of the banking system. I am also encouraged to see that there is now a broader appreciation among eligible institutions that Federal Reserve liquidity facilities are an important part of making sure that firms can weather a variety of market conditions. It is important that firms are ready to tap facilities when the rates they face from private market participants are higher than the rates offered on the facilities. In this way, the facilities can serve to support interest rate control and broader market functioning. Turning to risks on the horizon, the Federal Reserve continues to study leverage in the Treasury market, and we have also been contributing to the Financial Stability Oversight Council work to study this issue as well. I want to recognize that leverage trading, including the so-called basis trade, can play an important role in capital markets. Basis trading serves a valuable function of market efficiency, improving the connection between cash and futures pricing, and facilitating access to futures for investing and risk management. Leverage allows market participants to arbitrage away relatively small pricing discrepancies, enhancing the integration of prices across economically equivalent instruments and markets. But leverage can also increase risks to both market participants and to Treasury market functioning, and must be managed appropriately by both investors and their counterparties, including through collecting margin to manage counterparty risk. Staff at the Federal Reserve and other agencies have done important work to analyze leverage in the Treasury market using available data. These studies have found that hedge funds are significant investors in Treasury cash, derivatives, and repo markets, that their highly leveraged positions in Treasury markets are facilitated by very low or even zero haircuts on their repo financing, and that demand for this leverage is highly concentrated among a handful of large hedge funds. Moreover, liquidation of leveraged Treasury positions by hedge funds appears to have contributed to the Treasury market stress in March 2020. All of us need to better understand this activity. The Federal Reserve collects information on the tri-party repo market through its oversight of Bank of New York Mellon, and the Office of Financial Research collects detailed information on repo trading centrally cleared through the Fixed Income Clearing Corporation. But as discussed at this conference, there has been much less information to date on the non-centrally cleared bilateral repo market, where much of this activity takes place. OFR's proposal to collect information on this market segment on an ongoing basis is an important step forward, and I look forward to their final rulemaking. The board also contributes to the official sector's visibility into the Treasury market by requiring banks that meet certain threshold requirements to report transactions in trace. Under this rule, 22 depository institutions began submitting their Treasury and agency MBS transactions on a daily basis to trace last fall. Although the bulk of transactions in the Treasury market are conducted through FINRA members, the addition of reporting by depository institutions has helped to ensure more complete coverage of the market. And we will continue to consider enhancements so that the collection aligns with FINRA's rules for its members and ensures consistent coverage of the market. While getting more and better data is crucial for fully understanding Treasury markets, some of the analysis in recent research raises questions about how the official sector can further support the resilience of the Treasury market. The Financial Stability Oversight Council's Hedge Fund Working Group has done excellent work to identify risks and offer recommendations to the Council on leverage trading. At the Federal Reserve, we will continue to work with the other agencies and market participants to identify and address risks to our supervised institutions and to the resiliency of Treasury markets. For instance, the capital requirements applicable to banks are one of our primary tools to help ensure that banks have sufficient capital to weather stressful conditions and continue to lend in good times and in bad. We and the other banking agencies recently sought comment on a proposal to revise these requirements to better reflect the risk of bank activities, and we are interested in views on whether the proposal achieves that goal. The people in this room and those watching online are well positioned to provide us detailed feedback on the capital proposal, including how different components of the rule could affect different markets. So I thank you in advance for your thoughtful contributions. I also want to highlight that the preamble to the proposal asks commenters for feedback on whether and to what extent sovereign securities should be subject to minimum collateral haircut floors, including, for example, repo-style transactions in which a banking organization lends cash against Treasury securities. While we are in early stages of exploring these issues, we appreciate commenter views very much. I have also taken note of some recent studies, including a paper presented at Jackson Hole, that have looked at additional factors that could support Treasury market functioning, including a move to broader central clearing, all-to-all trading, and also ensuring that risk-based capital requirements, rather than the enhanced supplemental leverage ratio, drive dealer balance sheet allocation. We are continuing to study these and other topics. I want to wrap up today by reiterating the importance of managing cyber risks. Cyber threats are constantly evolving, and we can expect them to become increasingly sophisticated as technology advances. It is vital for financial institutions and those who provide critical services to them to understand vulnerabilities in their systems and make necessary investments to remedy these vulnerabilities. These preventative measures are necessary, but not sufficient. It is also imperative for firms to build resilience to cyber incidents by developing and regularly testing business continuity plans. This is another area where we can never become complacent and where contingency preparedness for an array of scenarios is vitally important. Thank you very much.
I'm now going to introduce Nellie Lang, Treasury's Undersecretary for Domestic Finance, who will be delivering the next set of keynote remarks. Undersecretary Lang was confirmed into her position in July of 2021. Prior to serving at Treasury, she was a senior fellow in economic studies at Brookings and also a visiting scholar at the IMF, a lecturer at Yale, and a member of CBO's panel of economic advisors. She held a range of positions over the course of 3 decades at the Board of Governors of the Federal Reserve System, including as the first director of the Division of Financial Stability. Please join me in welcoming Undersecretary Lang.
So good morning, and thank you all for being here today. I'm going to see if I can get my slides going. I'm going to use some slides. This looks like Michael's slide, not my slide. Okay, so thank you. Been looking forward to this annual conference and this opportunity for everyone here, official sector, academics, market practitioners, to come together. And as I said last year, an important mission for us collectively is to strengthen the resilience of the Treasury market. My remarks this morning will focus on 2 parts then. First, a review of Treasury market conditions and market liquidity this past year. And second, a brief discussion of progress made by the Interagency Working Group on Treasury Market Surveillance, IAWG, with a focus on a few work streams that are led by Treasury. So as this audience is well aware, it's been an eventful year for Treasury markets, and interest rate volatility has been high. Against an economic backdrop of a strong labor market and higher than desired inflation, interest rates rose sharply, as did market volatility. The FOMC increased the target range for the funds rate from 5.25% to 5.5%, and the 10-year Treasury yield touched 5% last month. The interest rate increases have been punctuated by financial sector stresses and geopolitical risks that have emerged in the interim. And as this figure 1 shows, volatility measures for Treasury yields have been elevated and they've been variable. Implied volatility for the 2-year Treasury, which is the blue line, rose sharply last year around the beginning of the monetary policy tightening cycle and spiked to an extreme level in March 2023, following the failures of Silicon Valley Bank, and Signature Bank, as investors revised sharply downward their expected path for monetary policy. Treasury market conditions, nevertheless, have remained orderly. Figures 2 and 3 illustrate the relationship between the implied volatility for rates, shown on the horizontal axis, and market liquidity, which is measured by our composite index of trading conditions. So implied volatility for 2-year Treasury yields, figure 2 show that in 2022 and 2023, the purple and gold dots have been much higher than in 2019 to 2021, which is the gray, yellow dots. And when it reached extreme levels in 2023, the purple, market liquidity conditions deteriorated. That's shown by the higher dots. While this relationship is worth more study, and certainly will be studied more, market liquidity conditions are not too far out of line with what a regression line would predict for this very high level of volatility that emerged. For the 10-year nominal Treasury, figure 3, the increase in volatility this year was not as sizable, and liquidity metrics for 2023 have remained largely similar to last year. Again, all the purple is bunched up, and clearly are significantly lower than in 2020, the orange dots when we had similar levels of volatility. And at the same time, as we can see in this next figure, transaction volumes reached new record highs in mid-March. This combination of large transaction volumes, including high volumes for the 2-year Treasury, and elevated volatility suggests the market was able to facilitate significant risk transfer during this episode. And we conclude that market conditions have been orderly. High volatility has affected market liquidity conditions, as is typically the case, while reduced liquidity, however, did not amplify volatility. We'll also want to just show in figure 5 how principal trading firms performed during this period. PTFs increased their activity in the Treasury market in March, providing a greater share of liquidity during this period of significant market stress. And this surge stands in contrast to the decline in the PTF share in March 2020. The different reactions of PTFs to the events of 2023 and 2020 will be subject for further study, but the higher share recently is more consistent with past behavior, such as in October 2014, which, as you may remember, prompted the official sector to initiate this conference to begin with more than 8 years ago. So moving on from this period, and I'm just going to put the volatility chart back up because it's it's an interesting chart. So we're moving on from this period of March. Downside risks from the banking stresses began to recede, and after the debt ceiling was lifted in June, Treasury rapidly issued bills to rebuild its cash balance. 10-year Treasury yields rose, initially more gradually than the short-term rates, but then sharply, and by nearly 100 basis points between the end of July and the end of October. The sharp increase suggests a notable rise in term premiums, the compensation that investors require for holding longer maturity debt, and which is generally to have been estimated to be persistently negative for many years. There are a range of explanations that we have heard for the estimated rise in the term premium, including some from the Treasury Borrowing Advisory Committee, TBAC, just a few weeks ago. Some have suggested that the expected path of short rates is higher than what is assumed in term premium models, as the resilience of the economy in the face of rate hikes has resulted in an upward revision to the long-run neutral rate of interest, or R-star. Greater volatility in macroeconomic data may also be contributing to investors wanting more compensation for risk. Others highlight the shift towards more price-sensitive investors as the marginal source of Treasury demand, with the Federal Reserve reducing and foreign reserve managers, at the very least, not adding to their positions in Treasury securities. We've also seen lower levels of demand from commercial banks. And adding to this dynamic are growing estimates of Treasury's borrowing needs from the private sector because of higher projected fiscal deficits or the Fed's quantitative tightening lasting longer than had been expected. In addition, we've heard that the correlations of stocks and bonds turning positive may be a contributing factor, as market participants may view Treasury securities as providing a less effective hedge for risky assets when the nature of shocks to the economy shifts from predominantly demand shocks to supply shocks. While there are many possible reasons, the rise in term premiums on sovereign debt does not appear to be unique to the U.S. or to this narrow time period, so the most plausible explanations should have some common cross-country commonalities. Moreover, it's worth emphasizing again that the recent increases in term premiums and volatility do not appear to be because of technical functioning issues. Rather, liquidity conditions have continued to hold up well. Finally, earlier this month, at the most recent quarterly refunding, amid the elevated volatility, we announced a decision to moderate the rate of increase in longer-dated coupon auction sizes, an action which was broadly aligned with the expectations of the primary dealers and with the recommendations of the TBAC. As always, we strive to finance the government at the least cost over time, and borrowing decisions are made within the context of our regular and predictable issuance framework. This framework considers a range of factors, including an assessment of demand at points across the curve. And in the past week, we've been monitoring a cybersecurity incident at the U.S. broker-dealer sub of Industrial and Commercial Bank of China, which provides clearing services for Treasury securities transactions. Treasury activated its cyber incident response procedures, which includes a sector-wide executive response group. The firm, ICBC-FS, moved to alternative processing, and the event did not spread to other firms, nor have a notable effect on Treasury markets. We are staying in regular contact with key financial sector participants and federal regulators, as well as continuing to assess potential effects on Treasury markets. So let me turn to the second topic, strengthening Treasury market resilience. While we've seen that Treasury market liquidity has held up well over the past year, even amid very high volatility, we have, and we should have, a very low tolerance for any significant disruptions to this very important market. The IAWG members have continued to work on a number of significant reforms to enhance the resilience of the Treasury market, and last week released a third staff progress report. Some potential reforms are quite complex and could have wide-ranging effects. And accordingly, we recognize that it is important for the IAWG members to work carefully, deliberately, with substantial public input, and that we attempt to coordinate initiatives in pursuit of this common purpose. I'll speak today to a few initiatives that Treasury is leading, and my IAWG colleagues can discuss some other initiatives. So let me start with an update on transparency for Treasury securities. When I spoke at this conference last year, I said that we sought to expand transparency in a gradual and calibrated way. I said we would walk, not run. And in the past year, we've been walking steadily and have made important progress. First, in February, FINRA, in consultation with Treasury, replaced the weekly reports on secondary market trading with daily reports. These reports also provide more information on trade counts and volume-weighted average prices for the on-the-run nominal coupon securities. We've received positive feedback from market participants about these reports, and by coincidence, this greater transparency was available just weeks before the regional banking stresses that I mentioned earlier, which allowed market participants to benefit from the enhanced information about Treasury market activity during that volatile period. Second, we've made progress towards the public release of detailed secondary market transaction data for on-the-run nominal coupon securities. And we are aiming for end-of-day dissemination with appropriate cap sizes. During the past year, we've worked with FINRA to improve the transactions reporting processes and to turn this proposed policy into a reality. Market participants have noted to us that capping the size of a trade in disseminated data would provide some protection for counterparties while still indicating to others that a large trade had occurred. And this practice is used in disseminating data in other fixed income markets. Market participants have generally suggested that caps should be simple and easy to understand, calibrated for differences in liquidity and interest rate risk across tenors, and that they should be reevaluated periodically. There also has been interest in releasing an uncapped data set with true trade sizes, but only months after execution to avoid any disruption to liquidity provision. And 2 weeks ago, FINRA submitted their proposed rule filing to the SEC to move forward with the transaction level dissemination as described. And we are hopeful that after a review of public comments and SEC consideration and approval, the proposed dissemination can begin soon afterwards. In addition, in line with our walk, not run policy, once we have had time to evaluate the effects of disseminating these on-the-run transactions, we'll consider possible next steps for additional transparency. So continuing on improving data quality and availability, in January this year, Treasury's Office of the Financial Research, OFR, proposed a rule to establish ongoing collection of data from the non-centrally cleared bilateral repo market, which has been the subject of much discussion already today, where transactions are conducted between two firms without a central counterparty. This market represents one of the largest remaining data gaps for the official sector on Treasury market activity. And filling this gap will provide data on primary dealers' counterparties, including hedge funds, and the terms of the trade, which should help us able to assess the vulnerabilities in this market. Specifically, the proposed rule would cover U.S. financial companies with an average of $10 billion or more in daily outstanding commitments to borrow cash and extend guarantees through these contracts. This threshold would include both overnight and intraday commitments. OFR currently is considering comments received from the public and expects to publish a final rule in early 2024. Another work stream is to monitor and assess the effects of leverage and liquidity risk mismatches to reduce possible fire sale dynamics in Treasury markets if private funds were to have to meet margin calls or meet investor redemptions in periods of stress. For example, we continue to highlight the need for funds to adopt anti-dilution tools to reduce the first mover advantage in open-end funds that hold less liquid assets. And additionally, the Financial Stability Oversight Council's Interagency Hedge Fund Working Group has been analyzing trends in leverage and potential funding vulnerabilities, building on the pilot data for the non-centrally cleared bilateral repo and other data that we have for this market. We are aware, and it's been mentioned many times today, of the increasing amount of attention being shown to Treasury cash futures basis positions, in which hedge funds take a short position in Treasury futures and an offsetting long position in cash Treasury securities financed by repo. CFTC data indicate that the gross volumes of futures have grown substantially over the last year and a half, with long positions in Treasury futures by asset managers and short positions by hedge funds. Repo market activity, particularly in the sponsored area, has also picked up. and some of which could be related to the cash futures basis positions. This basis activity can provide benefits to the markets by increasing the liquidity of Treasury securities, improving integration between related cash and derivatives market segments, and translating demand for futures into demand for Treasury securities. At the same time, we are attentive to the potential risks of a disorderly unwind of leveraged positions, especially those reliant on rolling over financing every day. And naturally, we are monitoring these developments closely because of these potential financial stability risks and also because of its potential effects on Treasury market liquidity and demand for Treasury securities. Okay, and finally, I'd like to address Treasury buybacks, which we announced in May 2023, refunding for the anticipated implementation next year. We've had extensive consultations with a broad variety of market participants, and we believe that buybacks can play an important role in making the Treasury market more resilient by supporting market liquidity while also enhancing our cash management capabilities. Let me highlight just a few takeaways from our ongoing work. First, for liquidity support, our intention is to conduct buybacks in a regular and predictable manner, cycling through each of our maturity buckets at least once per quarter. While cash management operations will be more episodic, their timing, nevertheless, will be predictable because they will be focused during periods of high cash inflows, such as around major tax filing dates. Second, Treasury intends to be price sensitive when evaluating which buyback offers to accept. We do not have an objective to purchase a certain quantity of securities. As a result, the amount we buy in any given operation might be lower than the maximum amount that we announce we are willing to buy. As a reminder, we've noted that our intention is to initially purchase as much as $30 billion per quarter in liquidity support operations and up to $120 billion per year for cash management. Third, we believe that liquidity support buybacks should improve the willingness of investors and intermediaries to trade and provide liquidity in these securities through the knowledge that there is a potential outlet to sell some of their off-the-run holdings. These operations can make intermediation capacity more readily available as we buy back hard-to-move securities that are in broker-dealer inventories and would otherwise absorb their intermediation capacity. However, given the caps on buyback amounts, our purchases would not be and should not be viewed as a substitute for any actions that could be taken by the Federal Reserve during periods of acute market stresses. So we'll continue to refine our operational design for buybacks, and we intend to provide an update on timing at our next quarterly refunding announcement on January 31st. Okay, so let me conclude. Despite the various shocks and stresses that have emerged during this year, Treasury market functioning has been orderly. The IAWG members have made progress on a number of reforms that have been laid out in our staff reports, but there is still more to complete. I'm confident that the IAWG members working with one another and with the market participants and other interested parties will make additional significant progress in this coming year. And efforts to continue strengthening the Treasury market and its resilience will serve us well in the years to come. Thank you for your attention.
Okay, thank you, Undersecretary Lang. It's now my pleasure to introduce Haosheng Zhu, Director of the Division of Trading and Markets at the SEC. He became the director in December of 2021. He's a professor of management and finance at MIT's Sloan School of Management. He's also served as a research associate at the National Bureau of Economic Research, the finance department editor at Management Science, and an associate editor at the Journal of Finance. He previously serves as an academic expert for the CFTC and the BIS, and was a member of the Federal Reserve Bank of Chicago's Working Group of Financial Markets. I'll note there will be some Q&A time available at the end of Haoshang's remarks, so please join me in welcoming him.
Thank you very much. Good morning. It is my great pleasure here to participate in this conference and to discuss our work at the Securities and Exchange Commission in promoting the efficiency, transparency, and the resiliency of U.S. Treasuries market. As is customary, I want to say that I'm speaking today in my official capacity as the Director of Trading Markets at the ICC, but my remarks do not necessarily reflect the views of the Commission, the Commissioners, or other members of the staff. I'd like to start by revisiting two salient themes that have been discussed and highlighted in today's conference, and indeed in the previous iterations of the Treasury Market Conference as well. Now, the first theme is the steady growth of this Treasuries market. This chart is based on the data publicly available from the Treasury Department. In 2001, the total amount of U.S. Treasuries outstanding is about $3 trillion. In 2009, it was about $7 trillion. In 2016, it was about $14 trillion, and today, in 2023, it is about $26 trillion. Another related fact is that the weighted average maturity of outstanding Treasury securities has also increased in the recent years. In 2009, the weighted average maturity was about 50 months, or just over 4 years. Today, it is almost 6 years at about 71 months. A back-of-envelope calculation suggests that the total dollar duration, or DV01, of Treasury securities has increased about 5-fold from 2009 to 2023. That speaks about the demand of intermediation in Treasuries market. Now, the second theme is the strong capital regulation on banks is a very important factor in managing the leverage in the financial system. This chart is taken from a Fed note published by Federal Reserve staff in August this year, showing the total leverage exposure as well as the composition of the largest 6 bank holding companies, namely the 8 G-SIBs minus the 2 custodian banks. The top slice, the darkest slice here, shows that the largest bank holding companies have increased and expanded their Treasury market activities in the past 5 years. But the Treasury market intermediation remains a small part of their total leverage exposure. And the total leverage exposure has only increased moderately from 2016 to 2022. Now, that speaks about the supply of intermediation by banks and their affiliates. Now, together, these two themes point to the important roles played by non-banks, or capital market intermediaries. They include exchanges, broker-dealers, alternative trading systems, principal trading firms, security clearinghouses, investment companies, among many others. Many of these, obviously, are under the ICC's regulation and supervision. The Securities and Exchange Commission has done extensive work in all these areas. None of it would be possible, however, without the thoughtful advice and constructive feedback from all the other agencies in the Interagency Working Group, including the Department of the Treasury, the Federal Reserve Board, the Federal Reserve Bank of New York, and the CFTC. Within the ICC, these important work streams are the result of a collaborative effort across divisions, including the Division of Trading Markets, the Division of Economic Risk Analysis, the Division of Investment Management, and other divisions and offices. In Chair Gensler's past speeches, he has talked about and provided an overview of key projects in all these areas. And in the remainder of my remark, let me dive into the areas and initiatives that fall within the remit of the Division of Trading Markets. The overarching theme of our work is to strengthen the capital market intermediation of the U.S. Treasury securities market. Now, broadly speaking, the Division of Trading Market regulates 3 layers of market activities and intermediaries. Marketplaces on the top, broker-dealers in the middle, and the clearance and settlement systems at the bottom. I will talk about 2 projects in each layer. In the marketplace layer, a critical project is the modernization of trading platform regulation. By and large, U.S. Treasury securities, in terms of the cash market, do not trade on registered securities exchanges today, like the NYSE. Instead, alternative trading systems, or ATSs, stand on the front line. In the second and third quarter of 2021, registered government securities ATSs account for about 1/4, or 24.5%, of trades volume in Treasury securities. An additional 9.6%, or almost 10% of trades volume, happen on trading platforms that are currently exempted from regulation ATS. In 2022, the Commission has proposed, among other things, to remove such exemption. The practical impact would be that trading platforms that use firm orders in U.S. Treasury securities, such as inter-dealer platforms that run limit order books, will be required to register as ATS and meet the investor protection and fair and orderly market principles of regulation ATS. Sufficiently large platforms would also be required to meet rules about fair access and the regulation SCI. The Commission has also proposed to expand the definition of the word exchange to include the use of non-firm trade interest, such as request for quotes and streaming quotes. These trading protocols fulfill a similar function as limit order books do, and should be regulated similarly. Trading venues, including those for Treasury securities that offer the use of non-firm trade interest and provide protocols for buyers and sellers to interact and negotiate the transaction, would be subject to the exchange regulatory framework, including registration as alternative trading systems. Enhancing post-trade transparency is another important project in the marketplace layer. Evidence from the last 20 years has shown that post-trade transparency in the fixed income market has reduced the transaction cost for investors. We deeply appreciate the Treasury Department's leadership in promoting more timely and granular price information in Treasury securities transactions. In addition, earlier this year, the Commission has adopted a new rule that requires public dissemination of trade-by-trade prices for security lending transactions on the next-day basis, including those for Treasury securities. The security lending rule would also complement the proposal by the Office of Financial Research that would require the reporting of certain repo transactions, which Undersecretary Liang just talked about. Let me now turn to the second layer of capital market intermediaries, the broker-dealers. The Commission has a robust and comprehensive regulatory regime for broker-dealers, including rules about net capital, customer protection, record keeping, among many other areas. Certain regulatory requirements are triggered only if the broker-dealer has custody of customer cash or security, such as the customer protection rule, whereas other rules apply broadly to all broker-dealers, such as net capital and record keeping. According to the Exchange Act, a dealer is defined to mean any person engaged in the business of buying and selling securities for his own account. Principal trading firms now account for a significant trading volume in Treasury securities. Again, in the second and third quarters of 2021, PTFs account for about 1/4, or 25.4%, of trades volume for on-the-run Treasury securities. Now, some of these PTFs are not registered, and yet they are engaging in activities similar to that of registered dealers. The Commission has proposed to further define the phrase as a part of regular business, which is used in the statutory definition of dealer and government security dealer. Therefore, if such rules are adopted, PTFs and others could be required to register as dealers or government security dealers. In addition, earlier this year, the Commission has adopted a rule amendment that narrows the available exception or exemption from Exchange Act, which requires that broker-dealers already registered with the Commission to also become FINRA members. therefore subject to, for example, trades direct reporting. Now, these two initiatives would help ensure that the market intermediaries that have evolved to perform the roles of dealers meet the regulatory standard of dealers. Now, the last layer of intermediaries consists of clearinghouses, which are essential for the clearance and settlement functions of the market. Central clearing reduces counterparty risk by increasing multilateral netting of transactions and by guaranteeing delivery of securities in the event of a counterparty default. Given the benefit of central clearing, the Commission has proposed in September 2022 to expand the scope of central clearing in the Treasury market. Currently, the clearinghouse for Treasury securities, namely FIC, requires transactions between two clearing members to be centrally cleared. Under the Commission's proposed rule, repo and reverse repo transactions in which at least one party is a member of the Treasury clearinghouse will be submitted for central clearing. The proposed expansion of the clearing requirements for Treasury cash transactions will be narrower and target specific types of transactions, including transactions intermediated by trading platforms that are also clearinghouse members. To facilitate and incentivize additional central clearing, the Commission also proposed rules to require the clearinghouse to adopt policy procedures for the separation of house and customer margin, to allow the onward posting of customer margin by broker-dealers to the clearinghouse under specific conditions, and to require the clearinghouse to facilitate access to clearing and settlement services. In a similar vein, the Commission has also proposed two other rules that would strengthen the governance structure of, and as well as recurrent one-down planning of all registered clearing agencies. All of these initiatives are aimed at creating a more transparent and efficient environment for central clearing, which in turn enhances the resilience of the financial system. I will stop here. Thank you very much. Are there any questions? I'd be happy to answer questions if there are any. Yeah.
Thank you. Yes, we are going to open it up for Q&A, so.
Thank you very much. Thank you very much, Mr. Hugh. Paul Hutchin, BNP Paribas. On the designation of non-traditional participants as dealers, several prominent voices have pushed back on that concept recently. I'm wondering if you could talk about sort of the concerns that they've raised into the formulation of the SEC's consideration of that designation, specifically through the lens of the concern that these currently non-dealers become dealers and potentially pull back from the market. Is the designation of them as dealers and the potential pullback from them as liquidity providers worth the risk? Thank you very much.
Thank you for that question. As you pointed out, after we issued the proposal on dealer and government secure dealers, we received really extensive comments. And kind of taking a step back, the statutory definition of dealer is extremely broad. It basically said anybody who is buying and selling securities for his own account would be a dealer. Now, of course, there's a parallel definition of brokers, right? That would be the people who buy and sell securities for others. That would be brokers. Because the dealer definition is broad, and in the past, there's no specific definition kind of embedded there to further refine it. There has been a long tradition in the case law to just kind of interpret what dealer means. Partly because of that, certain market participants that behave like dealers are not registered, even though the similar activity I would see in equities market. These same players are registered as dealers or broker-dealers in the equities market, such as principal trading firms. So we are not trying to make it hard for market participants for intermediation, but rather we're simply saying that for certain segment of the market, such as U.S. Treasuries, so important and for the whole economy, intermediaries there should meet existing standards that people are already meeting for equities and options and other markets. So we're considering all the comments very seriously, Of course, we will welcome additional engagement from market participants. So all the concerns are heard loud and clear, including how broad the rule is, and we consider them very seriously.
Thank you for your comments. Mark Cabana, Bank of America. On the central clearing for Treasury cash and repo, any updated guidelines or guidance to the market on potential rule finalization, implementation timeline, or how the phase-in process may work? Thank you.
Well, thank you. Treasury clearing apparently is a salient theme in today's conference, and we are very happy to be part of that. So as you pointed out, Treasury clearing, some of the comments, as you just reiterated, centers around the phase-in and also implementation timeline. Obviously, I cannot say anything too definitively around the head of the Commission in terms of the final adoption. But I would say that in terms of the phase-in, we hear the comments loud and clear. We do want to make the solution eventually workable for market participants, affording enough time for people to get on board. On the other hand, I think this is also a theme kind of discussed in today's conference. There's heightened volatility, there's growth in the market, so there is also a sense of urgency, I think, across multiple regulatory agencies that we should do whatever we can as soon as possible to enhance the resilience of the system. I think a silver lining in all of this is that in the past 10 years, swap clearing has been very successful, and there is substantial amount of voluntary central clearing for U.S. Treasury repo transactions. So the market has already familiarized itself with that process. So again, I just want to reiterate our appreciation of all the comments received, including yours, and we welcome additional feedback right there.
Yeah, Bernard Goyder, Risk Magazine. Did you intend, when you put the broker-dealer registration rule out, to include hedge funds and large asset managers in that? Because by putting a threshold on trading activity for treasuries, I think the MFA and other organizations have pointed out that actually brings in a lot of firms that we traditionally associate as buy-side firms rather than sell-side firms.
Sorry, are you talking about the dealer proposal or the Treasury clearing? Dealer one? Yeah, this again kind of brings back to the dealer definition. The dealer definition by statute, again, is very broad. There are existing case law interpreting what the dealer means. We certainly understand the market concern that if you're a buy-side investor and you invest in Treasury securities, and the investment activity is really investment rather than buying and selling, dealing, maybe that should not be scoped in. So we heard that comments. Again, this is something, give us a little time, and we will arrive at a very reasonable place. Right, thanks so much.
Thank you. My pleasure to introduce Anna Nordstrom, a Senior Vice President and Head of the Domestic and International Markets Function here at the Federal Reserve Bank of New York in the Markets Group. In this role, Anna is responsible for the Treasury markets, money markets, and mortgage markets open market trading desks, which carry out monetary policy operations as directed by the FOMC and provide fiscal agent services to the U.S. Treasury. She also manages the Foreign Reserves Management Directorate, the Foreign Exchange and Global Markets Directorate, together which are responsible for managing the euro and yen denominated assets of the U.S. foreign exchange reserves, executing U.S. foreign exchange related activities on behalf of the Federal Reserve System and the U.S. Treasury, and the Federal Reserve Bank's liquidity swaps, along with marketing and monitoring of international financial markets. Ms. Nordstrom is an ex officio member of the FXC and the TMPG, and also represents the New York Fed on the Global Foreign Exchange Committee. Before joining the New York Fed in 2008, Ms. Nordstrom had held positions at the ECB, the IMF, and the Central Bank of Sweden. Ms. Nordstrom studied public administration at Umeå University in Sweden. Please join me in welcoming Anna Nordstrom.
Thank you very much, Brett. Good afternoon. It is a pleasure to speak with you today at the 2023 U.S. Treasury Market Conference. I appreciate the opportunity to engage with so many thought leaders across the industry. This is a unique forum for the diverse set of Treasury market investors to engage with the official sector and academics. In my remarks today, I would like to discuss the important role of one subset of that diverse investor base, the foreign investor. I will explain how the key properties of the Treasury securities, specifically their liquidity and safety, attract foreign official and private investors alike, and how this relates to the role of the US dollar as the primary international reserve and investment currency. I'll then conclude by reviewing the Federal Reserve's repo facility for the foreign official sector and how it supports Treasury market functioning. Before I begin, I would like to note that the views I express today are my own and do not necessarily reflect the views of the Federal Reserve Bank of New York or the Federal Reserve System. According to Treasury International Capital data, foreign investors hold about $8 trillion of Treasury securities, which is about 30% of the market. This is a very large share. The high degree of foreign interest reflects the liquidity, reliability, and insurance value of treasuries in a diversified portfolio. Foreign treasury holdings are split nearly equally between the official sector, which is mostly central banks and sovereign wealth funds, and private sector, which includes institutions such as banks, insurers, hedge funds, and pension funds. So why are these various foreign investors drawn to US Treasury securities? This diverse set of foreign institutions are attracted to treasuries for an equally diverse set of reasons. For one, the liquidity of the treasury market is critical for reserve managers and is highly valued by all investors that seek to maintain a diverse securities portfolio. Many reserve managers have liquidity as the primary objective for the foreign reserves to ensure ready access to funds. Trading conditions in the treasury market have been front in mind this past year, as high levels of market volatility have resulted in intermediaries adjusting how they provide liquidity. Even so, it is important to recognize that this adjustment appears largely commensurate with the increased level of market volatility and without interruption to market functioning. Investors have been able to transfer risk effectively across both on and off-the-run securities. In addition to trading liquidity, treasuries offer safety since they are backed by the full faith and credit of the United States government, with recourse to the independent US legal system. For reserve managers, maintaining a high degree of safety is essential for ensuring foreign reserves are reliably available to meeting liquidity needs. Lastly, US Treasuries provide a diversification benefit and insurance value to investors that pays out in an uncertain world. The future is ultimately unknowable, and time and again, we are reminded that allocating to safe and liquid assets can protect portfolios from the unexpected. The liquidity and safety provided by treasuries to investor portfolios is real. To this, I want to highlight that during recent periods of high market volatility, foreign investors as a group actually increased their allocations to US Treasuries. For example, we can see that the foreign private sector has increased its share of US Treasury holdings for the last 3 years after controlling for market valuations. This high degree of interest is occurring despite FX hedging costs eroding most of the yield gain earned by buying treasuries. We think that this is a testament to the fundamental value of treasuries within a well-diversified portfolio. While the share of US treasuries held by foreign official sector has declined slightly in recent years, this change appears to largely reflect idiosyncratic factors, with some reserve managers decreasing and others increasing their holdings as global FX reserve levels have plateaued. The Federal Reserve plays a key role in promoting financial stability and supporting the smooth global use of the dollar. To this end, the Fed maintains a repurchase facility for foreign and international monetary authorities, also known as the FEMA Repo facility, in part to support a well-functioning treasury market. These foreign account holders can temporarily exchange treasury securities for dollars to meet potential liquidity needs through repo transactions with the Fed, rather than relying solely on the market. Despite limited and sporadic usage, there is evidence that the facility demonstrates its capacity to effectively serve as a timely liquidity backstop and minimizes the need for asset sales to address dollar liquidity needs. This facility also expands the reach of the Federal Reserve's provision of US dollar liquidity overseas beyond its network of dollar liquidity swap lines. As I wrap up, I want to emphasize that the liquidity and safety of the treasury market is what makes it unique within the investment world. And the strong presence of the foreign investor is a testament to those qualities. The large-scale participation of foreign private and official investors helps make the market resilient across many states of the world. Thank you very much.
Welcome back, everybody. I hope everybody enjoyed lunch. We're pretty close to being on time, but we'll jump right into our second panel. This panel is going to focus on assessing recent Treasury market resiliency and liquidity, and we will be reserving some time at the end for Q&A with the audience. For the discussion, I'll be handing it over to Ellen Correa-Golay down on the end, who will be moderating the panel. Ellen is a Treasury Markets advisor in the Markets Group at the New York Fed. In this role, she leads cross-agency work related to Treasury market resilience and provides thought leadership to the open market desk. Additionally, Ellen serves as the New York Fed's senior liaison to the TMPG. Previously, Ellen oversaw the 2020 large-scale purchases of treasuries launched in response to the pandemic. With that, I'll pass it over to Ellen and the panel.
Right? Yes, great. Okay, so as Brett said, in this panel, we will review the recent performance of the Treasury market amidst higher volatility, looking particularly at trading behavior, market resiliency, and liquidity. Additionally, we will consider potential initiatives to bolster the resilience of the Treasury market. Before we start, I have to give the standard disclaimer that any views I might express are my own and not those of the New York Fed or the Federal Reserve System. I'm going to start off by introducing my esteemed panelists. Ching Chen is the Managing Director and Co-Head of North America Rates Trading at Morgan Stanley. She began her career at Morgan Stanley as an interest rate desk strategist in 2009 before moving to the interest rate swaps trading desk in 2013. Since then, Ching has held multiple positions, including head of the interest rate swap trading desk, head of linear rates, and most recently, co-head of North America interest rate trading. Michael Fleming is the head of capital market studies within the Financial Stability Policy Research Division at the Federal Reserve Bank of New York. His primary research interests are market microstructure, financial intermediation, and monetary policy. His recent work examines Federal Reserve liquidity provision during the pandemic, the evolution of Treasury market liquidity and its drivers, and the effects of market structure changes on intermediaries and market quality. Michael joined the New York Fed as an economist in 1994. Mark Seidner is CIO for Non-Traditional Strategies and a managing director at PIMCO. He is also a generalist portfolio manager and a member of the investment committee. He rejoined PIMCO in November 2014 after serving as head of fixed income at GMO LLC And previously, he was a PIMCO Managing Director, Generalist Portfolio Manager, and member of the Investment Committee until January 2014. Prior to joining PIMCO in 2009, he was a Managing Director and Domestic Fixed Income Portfolio Manager at Harvard Management Company. Colin Teitschultz is Principal and Head of Markets at Element Capital, a macro hedge fund. From 2011 until he joined Element Capital in 2019, Colin was Portfolio Manager and Head of Fixed Income at Blue Mountain Capital, and Partner and Portfolio Manager, managing multiple funds and strategies at Pine River Capital. For the first 19 years of his career, Colin was a fixed income trader at Goldman Sachs and Morgan Stanley, managing teams trading mortgage-backed securities, emerging market debt, U.S. Treasuries, and interest rate swaps. And finally, we have Mark Wendland. He's a partner at DRW and serves as the firm's Chief Operating Officer. Mark joined DRW as its Global Head of Treasury in 2019. Mark previously worked at Citadel, where he led its U.S. operations, global fixed income finance, counterparty strategy, and relationship management business units. So please join me in welcoming my panelists. Okay, let's dive in. I'll start by asking the panelists some discussion questions, and as Brett mentioned, we'll try and leave some time at the end for audience questions. There have been several high-profile events over recent years that have displayed fragilities in the Treasury market. The strains of 2020, Dash for Cash, the 2019 repo pressures, and of course the 2014 flash rally that was what started this conference 9 years ago. Let's start by getting a lay of the land and understanding how Treasury market liquidity has fared more recently. Michael, I know you've done some research on this recently. Could you share with us your findings?
Definitely. And let me also start with a standard disclaimer that the views I express are my own and not necessarily those of the New York Fed or the Federal Reserve System. Work I've done and work I've done with others suggests that liquidity has been challenged in 2022 and 2023, especially around the bank failures in March this year. But that liquidity has not been unusual once one controls for the level of volatility. So in that sense, my message is going to be very similar to that presented by Nellie Lang earlier. To step back, I basically see market liquidity as the cost of trading. So a liquid market is one where one can quickly trade in the desired size at a low cost. I often assess Treasury liquidity by looking at bid-ask spreads, order book depth, and price impact, and all of these measures suggest heightened illiquidity in 2022 and 2023. That said, volatility has been high as well, especially in the short end and especially in March of this year. Not surprisingly so given uncertainty about the economic outlook and uncertainty about the path of interest rates. Now, higher volatility could be expected to increase the cost of market making, leading to wider spreads, lower depth, and higher price impact, and that's just what we've seen. So one simple analysis we've done is to plot the relationship between price impact and volatility. And you see that there's kind of a nice linear relationship between the two. This is kind of similar to the charts that Nellie presented earlier. So higher price impact is associated with higher volatility. And the points in 2022 and 2023 kind of lie along that line. Now, in contrast, there are times when liquidity is worse than would be predicted by volatility alone. And March 2020 would be a great example of that. So as far as this last point, it's something that we explore in a recently released working paper, work I did with some colleagues and with Professor Darrell Duffy at Stanford. And so we show that liquidity in March 2020 was not only exceptionally poor, but it was poor even controlling for volatility. And one thing we explore is that measures of dealer capacity seem to help explain why liquidity was so poor at the time. So anyway, one takeaway from that work is that dealer capacity is something that we think we might want to be tracking going forward as well as liquidity.
Great. Ching, in your experience, how has the liquidity profile of various Treasury market sectors changed over the recent volatile episodes? Are there particular segments that perform better, others not so much?
Yeah, so we look at liquidity using similar measures, top of stack available size.
and the sweep cost. So the bid offer you have to cross to get, say, 100K DV01 of single instrument. And we also look at post-trade market impact or decay. So all measures are pointing towards challenging liquidity in the Treasury market. And generally speaking, the bid offer to get 100K DV01 is still elevated at about like 1 basis point or more. Treasury futures tend to have better liquidity than cash, and that sweep cost is sitting around 0.6 basis point, so 40% lower. But to Mike's point, it's very closely tied to the volatility of the market. And Treasury market liquidity started to deteriorate really at end of 2021. That was when top-of-stack liquidity reduced by more than 90% and has never since meaningfully recovered. And that was exactly when markets started to price some hiking probability and volatility picked up. And since then, most of the volatility of the market was driven by uncertainty in the policy rate path. So the volatility was concentrated in the short end of the curve. And as a result, we noticed 2-year futures and 2-year cash had the most challenging liquidity. So for most of this year, 100K DV01 of 2-year Treasury was not available. And during the peak of volatility episode in March, market was not available for 25K DV01 of 2-year Treasury. And even 2-year Treasury futures was not available. And market impact was most dramatic. So again, closely tied to the volatility. But since September, August and September, the theme of the market shifted towards term premium repricing. So backhand yield rose very quickly. 30-year rose 100 basis points in a fast fashion. Meanwhile, the 2-year part of the curve actually started to become a bit more range-bound. And the liquidity profile actually shifted consistent with the volatility profile. So what we've noticed is since third quarter, front-end liquidity has improved. So 100K DV01 of 2 years started to become available as the terminal rate distribution became better defined. And the 2-year Treasury future liquidity improved by about 0.2 basis point since earlier in the year. And on the 30-year, though, it's the other way around. Since September, the sweep cost for 30-year actually moved higher by about 0.3 basis point for 100K. One thing worth noting, though, is even though liquidity condition has been challenged, risk transfer has continued throughout the time.
Great, thank you for that. Do any of the other panelists have views on this? All right, we can carry on. So next, I'd like to discuss how market participants have adjusted to the higher volatility regime. Colin, how have market participants generally adapted trading strategies, execution, or positioning across cash, repo, and futures?
I agree with the comments about the changes in market volatility roughly and liquidity roughly aligning. And I think that behavior of market participants has been somewhat consistent with that. So, the types of positioning that people take, I think, have evolved. There's, when I hear anecdotally about positions people take, smaller positions because you get a lot more volatility per unit of risk. So that seems sensible. I think that's certainly true for directional type positioning. And probably to a certain extent for curve trading as well. On the other hand, with the increased amount of volatility, I think there's been an increase in opportunities for relative value trading. And notably, there's always this discussion of cash futures basis trading. As the amount of issuance has been increasing very significantly. And some of the natural buyers of that issuance have chosen to absorb that duration in futures contracts. That creates this bid for futures that's being met by sellers in the form of the basis trade. And I think has been mentioned by others today, without that outlet, without that selling, presumably the value of that basis would become much more distended and become much more problematic. I would say that kind of a structural shift that's occurred over the last, call it 12 or 18 months, is a shift away from less price-sensitive buyers in the Treasury market. So away certainly from the Fed, but also from some of the overseas reserve manager buyers, and to some degree away from bank portfolios, who I think has been previously mentioned were gathering a lot of deposits and needed to essentially hedge those deposits. And so the buyers who are left in the market are what I would describe as very price-sensitive buyers. So these are asset managers and retail investors or households and hedge funds. And so that's meant that in order to attract demand when it's required, prices need to move to a level that that set of price-sensitive buyers finds appealing, or else they just don't show up. They don't have a structural reason why they necessarily need to buy. And I think that helps to explain some of the ongoing increase in volatility, especially further out the curve, is that there's certainly uncertainty about the economic information, uncertainty, less uncertainty perhaps around the Fed than there had been, say, 6 or 12 months ago. But nevertheless, if for whatever set of factors, technical or fundamental, that exist in the marketplace, if that discourages buyers or encourages buyers, we seem to be getting much larger, much more rapid moves. And I don't see a reason why that's likely to shift.
Thank you. Mark Wendland, I want to ask you a question. We sometimes hear the narrative that PTFs tend to pull back in more volatile environments, although, as Nelly's remarks showed today, that's not always the case. What's DRW's experience?
Sure. So I can comment on DRW's experience. I think there's also the natural instinct to bucket groups of firms in PTFs, hedge funds. Each firm is unique in their approach to markets, so I'll comment on DRW. We saw exactly the opposite. So similar to what Nelly had said earlier, and then I think Professor Duffy also made comments at a previous conference about some of the data that actually disputes that. So look at March 2020, we saw our market share in the derivative space increase 60%. So that's kind of us embracing the volatility and what we pride ourselves on, being able to be a trader and take on risk and the ability to warehouse risk. Even, which we haven't talked about a lot, I was actually surprised that we haven't talked about last week's events as much, but with a cyber attack and the ability to step in, and so we saw our risk positioning kind of change on a day-over-day basis by over 85%. So those are examples of where PTFs kind of strap in and actually take advantage of those, where you want people to take in risk and kind of close any dislocation that may present itself. And I think there's other discussions that have been had about registration as dealers and what that means. And I think if you're using registration as dealers as a means to curtail this flightiness of PTFs, I think it actually does the opposite. I think it actually encourages people to potentially step away from the market, and you want actually people to step in. We should be encouraging more participation in the Treasury market. As we've talked about from other panels about the slope of Treasury issuance, we want a more active participant list.
Great. Does anyone else on the panel have anything to add? No. Okay, great. So now I'd like to talk a little bit about the resilience we've seen in the market recently. The Treasury market seems to have handled the high volatility regime rather well. There's been several incidents over the last few years, including the US banking episode earlier this year, the UK LDI turmoil in the gilt markets, and then of course the volatility in long rates this fall that Ching was talking about earlier. Ching, do you feel that the Treasury market's performance through the events signals that the market's more resilient than we might have previously thought? And are there any lessons learned from this experience that we can take?
Yeah, thank you, Alan. Yeah, I would say Treasury market overall has been more resilient than I expected, especially its performance during this sustained high volatility period over the past 12 months. The most significant volatility period was March during the regional bank crisis, so I'm going to focus a bit more on that. When I compare to this year, March, versus starting of the pandemic in March 2020, market actually experienced much higher vol this year. So 2 year had the biggest 3-day move since 1987. And the volatility spiked to the highest level since Great Financial Crisis. But when I look at risk transfers were going through more smoothly compared to 2020. And the off-the-runs did not really get cheaper. And the financing market or funding market being working orderly. So I think these all point towards more resilience in the Treasury market this year. So I'd attribute that to 3 factors. First of all is the money flow has been very smooth. Fed quickly reacted and established the bank term funding program, and that helped to calm down the market. And in addition, the reverse repo market served well as the liquidity buffer. So during March, the banks that needed liquidity, needed funding, managed to get it through the market. Second factor is from a market making seat, one observation was that the leverage in the system was generally lower this year compared to 2020 in the Treasury market. So I think each time there's a VaR shock, market participants tend to incorporate that into their portfolio analysis. So the tails got better understood, and the portfolio or overall position got better hedged. And I think that was the case this year. From a dealer seat, we noticed de-risking and deleveraging happening at a very early stage, and it was happening in a very orderly fashion. And today, I think now the March 2020 scenario now become an input to the portfolio analysis. So to the extent that if a similar crisis happens again in future, I think the market is likely to be better prepared for that. And thirdly, I think also very important is dealers' ability to intermediate was very important. So again, March 2020, I think the main issue was dealer was reaching capacity. So they were not able to intermediate in the market. This year, on the other hand, volatility was mostly driven by uncertainty in a rising rate environment and uncertainty in the banking sector in general. So as a result, dealers widen out their pricing, widen bid offer to account for the unknowns and to account for the rising hedging cost. But dealers were able to price large risk transfers. So even though, for example, 25K DV01 was not available for the front end in the public market, dealers were managed to price block transactions. The CME data showed that the Treasury future block transaction actually went up by 40% in that month. So I think markets are constantly changing, and one crisis is not going to be the same as last. And we are also in a new regime now where I think the volatility is here to stay. So I think dealers' ability to intermediate is the key to providing liquidity and ensuring proper functioning of the Treasury market in times of uncertainty.
Great, thank you for that. And that sounds consistent with the research that you were citing, Michael, about the dealer capacity really affecting liquidity in the market.
That's right.
Mark Seidner, are there some successes we can see from the past year or two that regulators or policymakers could build on?
The answer is obviously yes, because I'll agree with everything that the panelists have said before me. I think there's a point to be made. I think markets are surviving bouts of volatility. It may be evidence of greater resiliency, but I'm not sure that any of us should be comfortable that that resiliency is a new permanent feature of the Treasury market. I mean, in terms of depth, we've touched on this a lot, but just at the highest level, since the financial crisis, dealer availability of balance sheet to transact is the same. The Treasury market is 4 times larger. And so just the simple math would tell you that there is a much smaller hole, or the hole's the same size, but the peg is much larger that you're trying to knock through the hole. And so anything that can be considered by regulators in terms of trying to create a more stable platform should be on the table in our opinion. You know, markets are surviving, but we're sort of getting used to 10 or 15 basis point moves on what seems like very little information, and that is a rather uncomfortable. I mean, CPI this week, the last two FOMC meetings, large moves with very little in the way of new information. Now, we'd be advocates of a couple advancements. First, anything from a regulatory perspective that creates additional scope for balance sheet by the primary dealers and the intermediators would be high on our priority list, whether that's SLR, whether that's central clearing. We'd be strong proponents. We'd also like to see some further democratization, honestly, of some of the programs and policies that are in place. As it comes to quantitative easing, or even the Treasury, the new program to buy back Treasuries, we'd love to see greater access for a broader set of market participants to affect or to access those programs, again, whether it's quantitative easing or buyback programs, because right now the gatekeepers are limited in some regard. And then we also think it's important to further consider, and there's been some work on this, but there can always be more work done on creating an all-to-all trading platform to make sure that even in periods of volatility, because we know that in periods of volatility that the ability to transact goes down, one way to potentially remediate that is to have a greater set of market participants be able to match each other to access greater liquidity. So those are some areas that we would think the regulators could consider or help advance within the private sector to even further enhance the resiliency and make market participants more comfortable. They're not just surviving bouts, but we are actually truly resilient to face the next crisis.
Great, thanks. Colin?
Yeah, so just a couple of thoughts of kind of the interaction of the official sector with the market. And going back to March 2020, as much as dealers were overwhelmed, I just don't see how dealers wouldn't have been overwhelmed in March 2020. And the reason I say that is, contrasting it with March of 2023. In March of 2023, we had shocking new information and we needed to reprice, and maybe there was some mispositioning and so on, so we had enormous moves. But ultimately, we were repricing rates to try to factor in that shock of what was going on in the banking system. In March 2020, we had a different kind of shock, and we had simultaneously all types of Treasury investors at the same time decide that they want to take advantage of the liquidity that they expect to have from their Treasury portfolio. The reason why, in some sense, why many people, maybe everyone holds Treasuries, is that in worst case scenario, I can turn these into cash at a reasonable price. And that works great for any one investor, any one group of investors. It works less great if all investors try to do it at the same time. And I think there's a fair amount of research out there, and depending on kind of what you want to see in the data, you can see that it was hedge fund selling, you can see that it was overseas selling, you can see that it was other types of real money sellers. It was all of them. And the only reason the market was able to stabilize is the Fed took the other side of everybody. I think subsequent to that, we got the FEMA facility and the standing repo facility. And so the next time around, we might have some shock absorbers in place that could conceivably make it possible for dealers to absorb that kind of cash need from everyone. And I think that's a big improvement to the system. The concern I'll express, and this is probably beyond the scope of today's discussions, but is policymakers, it's not Treasury's decision, obviously, but policymakers congressionally and in the administration choose to run extremely large deficits now and, according to CBO, for as far as the eye can see. We're just going to push on this market more and more. We're going to make the scale of Treasuries bigger and bigger relative to the scale of the economy. And we're making some incremental steps, which is great to make the market more resilient. But I don't think we're doing things that are really increasing, as you were saying, the balance sheet capacity of dealers to absorb an ever larger market. And I hope that at some point there's some rationalization of that.
All right, maybe just building on this discussion more and thinking about these policy proposals, Michael, if you think about some of the proposals out there, other ideas, and on two dimensions, those that might have the biggest impact and those that might be the easiest lift. Are there any that kind of float to the top?
Sure. I'll start with the second. So in terms of like ease of implementation, I mean, I think there are kind of natural differences between, say, increased data transparency and increased central clearing. So, I mean, data transparency, I think, is inherently, somewhat easier to implement, especially if the data is already being collected, and also probably easier to implement incrementally. And in fact, so, this is, I think, why we've seen, for, say, Treasury Trace, we saw some improvements in data transparency earlier this year. We know that, further improvements are already planned going forward. Central clearing, in contrast, there are obviously like important and complicated logistical issues involved in bringing trades into central clearing that involve counterparties that aren't CCP members. In terms of benefits, I mean, I'm not going to rank, the different proposals. I mean, let's say all-to-all, I feel, is something that it's been discussed more as something that, in terms of maybe what are the conditions that might make all-to-all more likely, and it seems that it may depend to a large extent on having increased central clearing and having increased data transparency. A final point is, comparing data transparency and central clearing. I think if you think about the benefits, rather than think about, ranking them in terms of which would be greater, I think it's important to think about that the positive impact might differ importantly between the two. So I think if you think about data transparency, I think there certainly could be some financial stability benefits from data transparency and people having a better idea of where prices are. But I think probably, maybe the main benefits, and at least the first benefits, would be more in terms of liquidity. So increased data transparency, lowering informational asymmetries, leading to better liquidity as evidenced by, say, lower bid-ask spreads. And there's a lot of evidence from, say, the introduction of corporate trace that is what happens. Whereas when I think of, say, central clearing, I think of first and foremost the benefit being improved financial stability. And that's something that can be a bit harder to measure and observe. Improved financial stability, that should indeed lead to better liquidity, especially at times of stress. It's possible that at first it actually leads to maybe somewhat worse liquidity during normal times, but with the offsetting benefit of improved liquidity at times of stress. And then also getting back to kind of some knock-on effects, if expanded central clearing were to pave the path or allow for increased all-to-all trading, then there could be, in fact, pretty substantial benefits to liquidity, both in normal times and at times of stress.
Great.
Just one point to add
Sure.
on that. And, I mean, data transparency is an important theme. We just worry a little bit about the differentiation between on-the-run securities and deep off-the-run securities, where data transparency in on-the-runs, I don't want to say it's unequivocal, but it's almost unequivocal that there will be an improvement in liquidity. I'm not sure that holds for off-the-run securities. I think there might actually be a cost to liquidity for off-the-run securities if they're depending on the timeliness of that data transparency.
Great, thanks. So Mark Wendland, do you feel like there's anything missing from this conversation? Are there solutions that are not being discussed or risks that aren't being appropriately elevated?
Sure. So I think it's important to think about the sequencing of these various different proposals. I think the overwhelming majority, we've spent a lot of time both at this conference and frankly last year is about transparency. And I think that's the first one, and frankly a little bit shocked we're still not completely transparent. And there is obviously to the official sector, which I think, again, getting the D2C and identifying who that C is to the official sector will help educate them, understand the market and the risk associated with it, to then get to the step 2 and 3 of potential other regulatory proposals, whether that be a clearing mandate or a dealer proposal, but the sequencing matters. Let's get the transparency to the official sector to better educate, understand all the different risks of the diverse participants that trade in the Treasury market, both in cash and repo. And then in the public trade reporting, I think is also something that should be considered. Now that one's a little bit trickier because there are safeguards that need to be put in place along with that, but I think that's another one that we should have a goal to get that out with the appropriate safeguards. On clearing, again, there's many benefits to clearing. I think there's also some things that need to be understood or changed in order to make it more accessible to all participants, because it is a very diverse set of participants that trade in the Treasury market. Another one that was talked about, I think, on a different panel is about the cross-margining, not only for house accounts for direct clearing members, but that also needs, if we're going to have a mandate, it also needs to be available to all of those participants that are now required to clear. In the dealer proposal, again, I think we need to exactly understand what we're trying to do. We understand the words on the paper may be broad, but there's also 89 years of interpretation on that definition that was meant to be about the nature of your activity, not necessarily about just the broad language to sweep in significant market participants.
Great, thanks. Anyone else have anything to chime in? No? Well, that's great, because that means we can go to audience questions now. So hopefully everyone out there has been pulling their questions together. Oh, David has one right in the front.
I understand, like if you believe that central banks, are less price sensitive and they're out, that you would think that the marginal investor might be more price sensitive. And I could get why that would make rates rise. You need higher rates to induce them. It's hard for me to explain, though, as you noted, right, recently we've seen some, the direction of the announcements, but they don't seem like they're huge and really big price swings. So I wondered how you all think about what you see happening right now in terms of, extreme, what seemed like very large moves to relatively smaller amounts of news.
I'll take a stab at that, I guess. I think that it's a somewhat unusual backdrop that we've got such a large amount of issuance hitting the market at a time when the economy is actually, at least until maybe the very most recent data, have been doing quite well, 5% growth last quarter, for example. And so we're implicitly asking investors to buy a lot of Treasury issuance at a time when people wouldn't necessarily be naturally seeking out that type of exposure. And then when you look at the shape of the yield curve, although there used to be significantly negative term premium priced in, nevertheless, the yield curve is still broadly negative carry to hold those Treasuries. And so that market structure, is, kind of as it's priced, I think when it appears like the economy is strong and that the Fed might even have to tighten more, looks like a very undesirable investment, and you get pretty rapid sell-off, as we saw over a 6-week period where long-end rates moved, 105 basis points. On the other hand, if the data weakens at all, and all of a sudden the discussion changes to the Fed could be easing a significant amount, which would be another way to turn this issuance into positive carry, and also might make Treasuries just like a more natural fit for investors who are choosing to buy rather than structurally needing to buy. You get rapid repricings the other way. And I think there's still an enormous amount of uncertainty about what the economy is actually doing. And therefore we have this kind of like what feels like hyperbolic sensitivity right now to these small pieces of data.
I mean, you've got an extremely uncertain environment where the benefit of taking no view has never been higher, speaking to the inverted yield curve. And so, when investors are faced with massive uncertainty and the cost of taking no risk is de minimis, you can see why that's a desired outcome. And you see it in fund flows. I mean, ultra short funds have had massive inflows this year, and even low duration portfolios, 1 to 3 year type portfolios, have had outflows, which sort of doesn't make much sense given the repricing you've seen in bonds. And it might also be, I think Colin sort of touched on this, you really just have a bimodal distribution of potential outcomes. And the base case seems like the most unlikely outcome in the tail scenarios, which there's plenty of passion on both sides of those discussions, and one side wins on one day and the other side wins on the next day, and that's what's creating the volatility.
Priya. Hi, Priya.
Thank you. Hi, Priya Mishra, JP Morgan. So thanks for all the focus on dealer capacity. So I've actually two-pronged question. One, is it a dealer capacity issue, which actually I heard seems like it's fine, something we should track, or is it elasticity of that dealer capacity? You get a March 2020, or even hopefully nothing as crazy as that, but what are thoughts on how should dealer capacity become more elastic in a shock event? How do you manage to expand that capacity? And the second question is around auctions. A lot of the discussion in the panel was on the secondary market. We're seeing more auction volatility. Is that something Treasury should think about? Are we just going to have to live in a world of more auction volatility? Or is that also an area where dealer capacity or elasticity of that dealer capacity is going to become important because dealers might be the back bid in an environment where some of the natural buyers of Treasuries or previous natural buyers of Treasuries are stepping away? Thanks.
All right, so one question about dealer balance sheet capacity versus elasticity, and then one about the recent auction volatility and how that interacts with dealer balance sheets.
I can start with
Go
the
ahead.
dealer capacity. In a way, I'm not sure I actually see the distinction, but the way I think about it is, the problem, say, in March 2020 is dealers were near their capacity and they could not quickly expand it. So if you want to, you could call that an elasticity problem or a capacity problem, but it's, yeah, they hit their maximum and there's, limited scope to expand, certainly, during a crisis, very quickly. As far as like what the solution is for that, I guess, there are a variety. One would be to think about, if that dealer capacity could be greater, but there are certainly other solutions, such as if there were a way to get increased all-to-all trading and dealers didn't have to be the counterpart to every trade, then maybe the market wouldn't need quite so much dealer capacity.
Yeah, I would also add, I think, because we talked about resilience, I feel like the market hasn't really been tested yet. So far it has been very resilient, but it hasn't really been tested. Because of the liquidity buffer there's a 1 trillion in reverse repo, but also because of some of the policy that's there that serve as like basically a backstop. For example, the standing repo facility, or we're talking about Treasury buyback that probably removes some of the tail of like large cheapening of the runs. So I think so some of those is yet to see. So far, because of the liquidity buffer, the market is functioning fine. And some of those policy in place, I think that generally speaking helps dealer capacity to intermediate risk or take down risk at times of stress.
So just to tie it to the auction, I guess, just looking at the long end auction last week, where you saw, I think it was around 25% dealer takedown, where I think if you look at the historical, it's around 10%. So you had like a 4 basis point concession, 5 bip tail, so 9 bip discount, and you saw them basically sell 3.6 billion of inventory that they otherwise wouldn't have taken down. And that's why you saw another 5 basis point sell-off immediately after the auction. And then it wasn't until really Chairman Powell's more hawkish commentary that kind of got the market back in line. So, I think it's hard to say that that auction, it was directly related to intermediation capacity, but the stats don't lie based on what is reported, 25% versus their historical average of 10%.
One other comment on auctions is it's not surprising that there should be more volatility around auction results in a market that is more volatile. And if you look at the data, you see that you see both some auctions that have bigger tails, but also some auctions that come through by a larger margin. I think there's just more volatility and more uncertainty in the process. I think looking back at the data over, let's call it the last year or so, it about washes out. It's on average not different. It's just that the variance of those outcomes is a lot higher. So I think there's not a lot of evidence yet that what's happening is just different from approximately what you would expect in a more volatile market. On the other hand, if we have more auctions like that 30-year auction from last week that you're mentioning, if that became a new trend, I think that would be more troubling.
Great. Well, thank you for those audience questions. I just want to close with one wrap-up question for the panel. And this is a yes or no question, so we'll go quite quickly. Do you feel the Treasury market is better equipped to weather volatility today than it was in March 2020? And we can just go down the line from Ching on.
Yes, today.
Yes.
Mark?
No. Somebody had to say no.
Yes.
Yes.
All right, great. Well, thank you all so much for this great discussion.
It's now my pleasure to introduce Russ Benham, Chairman of the U.S. Commodity Futures Trading Commission, who will be delivering keynote remarks. Chair Benham was sworn in as CFTC Chair in January of this year and had originally joined the CFTC as a commissioner in 2017. At the CFTC, he has focused on prioritizing customer protections, examining potential systemic market risk, the global transition away from LIBOR, and risks that climate change poses to financial markets. In addition, he spearheaded the effort to establish the CFTC's Market Risk Advisory Committee's Climate-Related Market Risk Subcommittee. We will reserve time at the end of his speaking to have Q&A with the audience. So please join me in welcoming Chair Benham.
Good afternoon, everyone. I have one slide. I had 4 slides last year, and it was a complete debacle, so I just did one. It's on this screen, so I don't know if someone from tech can help get it up top, but there we go. A theme of the speech, perhaps. Good afternoon. Again, pleasure to join you today at the Federal Reserve Bank of New York. I do want to thank President Williams and everyone at the New York Fed for hosting this great event. As many of you know, the New York City Marathon took place here just over a week ago. And though the course did not wind its way through the financial district, it covered all 5 boroughs of New York City and hosted just under 52,000 runners from 148 countries. Over 2 million in-person spectators set an all-time record for subway ridership, securing New York standing as the largest marathon in the world. Marathons and marathon training, with an estimated 1.1 million marathon finishers worldwide annually and 50 million Americans participating in some form of running or jogging, yield a lot of data. This is especially true now that most of us have swapped out a traditional wristwatch for a smartwatch, allowing us to effortlessly share data on dozens of physical activities with services like Strava, which aggregate, analyze, and socialize it through social media. Strava provides its subscribers a means to track their progress, connect with others, and explore greater opportunities, but it also provides a vast universe of data and metrics that can help answer questions well beyond where you can map out a quick 10K before work. A recent analysis of Strava data across 6 major marathons aimed at learning more about qualifying for the prestigious Boston Marathon yielded some pretty fascinating thoughts. For example, the data showed that despite the instinct to just go all out all the time, there was a strong positive correlation between keeping training runs slower and ultimately hitting goal pace on race day. The slower runs help build capillary beds and a stronger heart, increasing endurance capabilities over time, whereas running too fast causes muscle and bone breakdown that can't be overcome by recovery. The course matters too, both in terms of conditions and who is out there running, dynamics, demographics, things like elevation changes, relative humidity, and the overall caliber of runners also impacts performance. The data highlighted the benefits of running negative splits, which is running the second half of the race faster than the first, and not surprisingly, experience matters. There's a definitive learning arc when it comes to pacing and fueling for race day that can only really be learned through the process of racing. None of this is flashy, it's just foundational. This is the 9th annual Treasury Market Conference. At our first conference in 2015, then CFTC Chairman Tim Massad differentiated the structural elements between the cash Treasury and Treasury futures markets. He also highlighted findings of a recent joint report on significant volatility events in the U.S. Treasury market and how the availability of data and continued efforts towards strengthening monitoring would be critically impacted by increased automated trading and cyber risk. That was nearer to the beginning of our current arc at the Commission. We're over a decade past the course-altering impacts of the Dodd-Frank Act and what its impacts were on market data. And with the rapid evolution of technologies far beyond the automated trading that captured our attention just a few years ago, the CFTC's data program is now running negative splits as we move forward and engage with the administration and within our regulated markets. The President's recent executive order on the safe, secure, and trustworthy development and use of artificial intelligence is meeting us mid-stride. The EO directs developers to share safety test results and other critical information with the government, while the government works to develop standards, tools, and tests to ensure safe, secure, and trustworthy AI systems. As a derivatives market regulator, the CFTC understands all manner of risk. We build our capabilities in lockstep with the market's trajectory, understanding that with any new challenges comes both promise and peril, using our experiences to hone processes and policies that are necessary to meet the course wherever it veers. I think we are well positioned to take an early lead. As I'll elaborate on a little later, we have already developed and deployed safe and secure AI and machine learning algorithms, and we are working alongside the administration and with international AI governance frameworks to ensure AI advances in the futures markets benefit from our past experiences. I can't stress enough the importance of teamwork when it comes to ensuring that the latest innovations in financial markets are evaluated for fitness within the regulatory fold. As I've said before, the entrance of market structures and participants who are eager to deploy all manner of fintech must comply with the rules of the road, and that is especially true when it comes to protecting customers, consumers, and the larger financial markets from fraud, money laundering, and other financial crimes. When the use of digital assets and related enabling technologies for illicit finance purposes threatens national security and may fund acts of war and terrorism, we must continue to aggressively demand that all market entrants implement and comply with Know Your Customer and anti-money laundering procedures and customer information programs. The CFTC is doing its part by bringing enforcement cases like those, including BitMEX and Binance. However, I believe we are capable of more if given additional authority in the KYC, AML, and CIP space, and welcome the opportunity to work with Congress on solutions. Today, I want to begin with some current insights into the U.S. Treasury market based on the more fundamental CFTC data that form our baseline analytics. I then want to talk about our progress with data infrastructure, organization, and analytics, and how that foundational building has prepared us to move forward from automated trading to address the risks and opportunities presented by incorporating artificial intelligence and machine learning into our day-to-day operations and policymaking. The U.S. Treasury market's stats ensure it maintains a comfortable lead in the world of elites. Indeed, the brand message for the Treasury market is that it remains the deepest and most liquid market in the world and a central component of the global financial system. Turning to CFTC-regulated markets, Treasury future markets are robust with very healthy open interest, volumes, and number of traders. For example, for the 10-year futures contract, open interest is on the order of 4.6 million contracts, with approximately 2,500 traders trading more than 1.7 million contracts on average per day. Demographically, there is a healthy field of traders with different businesses and risk profiles whose provision of liquidity enables effective risk transfer and hedging by banks, asset managers, and other institutional market participants. The Treasury futures markets has kept pace with the Treasury cash market as the cash market has increased in size. For example, open interest for Treasury futures at the end of fiscal year 2023 was just over 19 million contracts, a notional of 2.3 trillion, compared with 2013's open interest of under 6 million contracts, notional of 650 billion. This corresponds to the growth in the U.S. government public debt outstanding from about 17 trillion to about 33 trillion over the same time period. Participant growth has widened in the futures market. The headcount of, quote, large traders holding positions in 10-year Treasury note futures and enumerated in the CFTC's commitments of trader reports grew from about 300 in 2013 to over 400 currently. I note this because the record positions held by certain types of traders should be placed into context. That is, to understand and appreciate the headlines, it's helpful to analyze the data. News stories have focused on potential impacts of the Treasury cash futures basis trade and highlight it's often the one signal of the trade that is publicly reported every week in near real time by the CFTC through the COT report. Treasury futures positions held by asset managers and leveraged funds. The breathless stories exclaim how the trade is at extreme levels and follows the same trending behavior as in 2018 and 2019, with reports of top regulators zeroing in on dangers and considering options. We must take a closer look at the highlight reel and hone in on the action itself. While there is a record number of contracts, this is consistent with historical relations between the size of the futures market and the size of the cash market. Large positions by asset managers and leveraged funds should be interpreted in the context of a larger amount of cash Treasury securities to manage by market participants. As we remember, the course matters. The COT report provides the headlines showing in large increases in net shorts by leveraged funds and large increases in net longs by asset managers, roughly over the past year. Getting a little bit further into the story, we're checking off the more obvious questions to really understand the field. Are positions getting larger because more participants are getting in, or is it because existing participants are holding larger positions? Alternatively, is there dramatic fluctuation in the participants driving aggregate position changes, or is it the usual cast of characters? And third, how heterogeneous and how concentrated are the participants within these groupings of trader types? We dive into the data to shed light on some of these questions and compare the futures positioning in the 2-year note futures contract in March versus September of 2023. This was a period when the net short positions held by leverage funds increased from just under 500,000 contracts to nearly 1.4 million contracts, well noted by the press. Net longs held by asset managers simultaneously increased from 700,000 contracts to 1.2 million contracts. To a large extent, these two categories of traders are dominating the market activity. Open interest grew from 2.3 million from 3.9 million contracts. So are new traders coming in, or are these the experienced traders maintaining their fitness? The data provides insight into dynamics and demographics. At the end of March, there were just over 400 large traders. By the end of September, there were just over 500. Roughly 100 entities eliminated positions between those dates, and roughly 200 added new positions, so the net result being about 100 more. But this change in the field was not the major driver of aggregate position changes. Like most contracts, the bulk of contract holdings are concentrated in entities holding large positions. For example, going back to March again, about 10% of the entities, 25 largest shorts and 25 largest longs, held over half of the open positions. Put another way, the top 50 entities held about 60% of the open positions, and the top 100 entities, or roughly 1/4 of the traders, held about 70% of the positions. Further exploring the field in both March and September, the largest net longs and net shorts were predominantly in one direction or the other. Most but not all of the 25 largest net shorts were leveraged funds, and most but not all of the 25 largest net longs were asset managers. Comparing their identities reveals that they were not a dramatic turnover of positions. Like elites on the course, many of the entities holding large positions in the spring remain and held onto even larger positions heading into the fall. Not only are they holding larger positions, but the 25 largest net short leverage funds more than doubled their positions from March to September. The positions moved from 1.4 million contracts net short to 2.5 million contracts net short. The largest 25 net longs also increased their positions, but not to the same extent. Additionally, the largest net longs in March increased their positions from 1.1 million to 1.4 million, suggesting a more concentrated increase among the shorts than among the long position holders. Back to the headlines, having weaved through a bit of the data, we at the CFTC can add to the context, provide some insights, and determine whether and what next steps are warranted. There is other relevant data, and the basis trade spans multiple regulatory agencies, with none seeing the full picture and understanding the true risks. And we all must remain vigilant. The CFTC is monitoring for any anomalies with the basis trade and activity in the Treasury futures markets, always with an eye towards ensuring market resiliency and integrity, and ready to use all of our tools and resources to do so. Like marathoners seeking a Boston qualifier, regulators have often taken varying approaches to achieving the data transparency goals envisioned by the Dodd-Frank Act. We have been successful in bringing about profound increases in transparency in both the swaps and in the secondary Treasury market over the past several years. In the swaps market, the crisis-induced time trials incented us to go out a little bit fast. But with some tweaks and incremental adjustments, we now have data on every swap market transaction that has occurred in the past decade. The Dodd-Frank Act required confidential data regarding swaps transactions to be reported to trade repositories and anonymized data for each swap transaction to be publicly disseminated in real time. Reacting to the then increasing opaqueness of the financial sector, these requirements sought to ensure that relatively raw data was available and shareable by regulators for oversight purposes, and that anonymized data was accessible to the public to perform price discovery and information generation functions. Dodd-Frank's vision for swaps data was based off then existing similar initiatives in the swaps and corporate bond market, the trade information warehouse maintained by DTCC, and trace reporting for corporate bonds. Dodd-Frank's swaps data requirements were far more ambitious than those prior efforts, and with a proven track record in the futures market, the CFTC took to the streets quite immediately. As the Commission continued along its data journey with the implementation of its 2020 swaps data rule in December of 22, the Commission was also working behind the scenes to prepare for the arrival of improved, more standardized swaps data. The Commission has been amending its historical data reporting requirements, such as reports by futures commission merchants, to incorporate standards already present in the swaps data, like the LEI. And as the Commission continues to move its historical data sets to a cloud environment, we are developing an architecture that stores our data sets, swaps and futures, in such a way that all of our data is linked by common standards and associated with individual regulatory requirements. This singular source for data will help us view our markets more holistically and better see the connections between the futures market and the swaps market and the risks that move seamlessly throughout. The CFTC, under my direction, moved to the cloud, achieved significant cybersecurity progress, increased the visibility of and added new leaders to our division of data, and launched a CFTC-wide technical training initiative. Our goal is the long run, building capabilities over time under the right conditions and with right people and pace towards organizational maturity and technical achievement. Simply put, it's a marathon, not a sprint. The recent cyber attack on ICBC Financial Services also highlights the importance of ensuring registered entities operating in our markets employ up-to-date cybersecurity measures. Fortunately, the cyber attack was discovered quickly, contained, and the manual process fallbacks appear to have worked as designed. While the full extent and impact of the event is still being unpacked, it's a stark reminder of how critical robust cybersecurity measures are to the financial safety of our registrants, as well as the integrity and resilience of our markets. This is one area where regulators may be able to take a lead. AI is and will be an important part of these efforts, and one that holds significant potential, particularly for supporting our regulatory and enforcement objectives. Also at my direction, the Commission has been building a forward-looking AI culture that complements our existing advanced analytics capabilities. That culture begins, of course, with talent. In a few weeks, the CFTC will welcome a new Chief Data Officer, and I originated and filled the new Chief Data Scientist position as well. The Commission is also leveraging the significant investments we have been making to move the CFTC's massive regulatory databases to the AWS cloud. The cloud's a game changer. It's like the Boston qualifier. It makes big data and big computing technologies accessible to smaller agencies like ours. More importantly, it enables our analysts and investigators to access the most advanced algorithms and AI at scale to perform analysis of unprecedented size and scope. The Commission's use of AI is not hypothetical. This summer, the Division of Data staff and contractors successfully built and deployed an AI model to detect data anomalies that were not previously detected in exchange-reported regulatory data. The output of this AI model streamlines the task of, quote, cleaning the data so that analysts and economists can expedite their day-to-day surveillance and long-term projects, thus building efficiencies. I cannot underscore my excitement about this great success by the Division of Data and our economists. A project that started a few months into my chairmanship has yielded unprecedented results and will act as a foundation for future growth and development that will take the CFTC forward, hopefully on an upward trajectory. The Commission is currently exploring other AI use cases. We have a process in place for exploring AI use cases targeted at helping us better monitor, regulate, surveil, and identify pockets of stress, and ultimately enforce compliance by identifying violative conduct. This process strategically aims to identify the highest return on investment projects to pursue. Not surprisingly, AI and advanced analytics hold particular promise in the enforcement space. The Division of Enforcement currently uses big data and advanced analytical techniques to identify spoofing behavior and other disruptive trading strategies in our markets. Existing algorithms have already identified multiple potential spoofing cases, including more complex spoofing techniques across markets, which have led ultimately to enforcement actions. Augmenting existing algorithms with AI will only enhance our ability to efficiently and accurately identify unlawful trading behavior in our markets. The CFTC has also entered the gates of natural language processing. The breakthroughs in NLP and large language models of the last years have stimulated a vibrant market for NLP code, tools, and other services. The CFTC has many straightforward NLP use cases around digitization, enhanced research, and process automation for the thousands of pages of documentation we receive every year in the form of PDF files, emails, and other unstructured formats. This work has a higher entry fee, so to speak, and will be prioritized over the next few years. My AI vision for the Commission complements the directives set forth by the administration and embodies what I believe to be good government. We are guided by 3 priorities: promoting responsible AI and innovation, understanding the application of AI for markets, market participants, and the larger financial system, and the impacts on all stakeholders, especially the public we serve, and identifying trends and their impacts within our markets and the broader economy. Over the years, we have learned that we can achieve our greatest regulatory and policy successes through engagement aimed at collecting data and information towards serving a clear purpose and unequivocally tied to protecting markets, market participants, customers, and consumers through the identification of potential risk. As a result of our ongoing work on AI and machine learning, and in response to the risks outlined by the executive order on AI, the CFTC staff will soon announce the formation of an internal task force focused specifically on AI in the derivatives markets. I anticipate that in the new year, the AI task force will issue a request for comment aimed at gathering information about the current and potential uses of AI by our registered entities, registrants, and market participants in areas such as trading, risk management, and cybersecurity, and of course, resilience. This request for comment will focus on concerns such as safety and security, mitigation of bias, and customer protection. The CFTC will use the responses to inform our supervisory oversight and evaluate the need for future guidance and other rulemakings. As always, my approach will be to be moved forward only after gathering information and data, engaging with stakeholders, evaluating the risks, and ensuring that we can make any market transactions seamless. Having roughly taken you through the 5 bureaus of thinking about our marathon data journey, My guess is that you're ready to cross that finish line. I certainly am. These remarks were not necessarily fast or flashy, but certainly foundational in our thinking. And after much training, the CFTC is truly hitting a plateau. And I think it's time to use our momentum to build up our capabilities and stand with the elites. Thank you very much. I don't know if we have time for questions or we're going to go to the, I don't know if anyone has questions. I'm happy not to take questions, but if anyone does have questions, I'm happy to take them. But we can move to the next panel if it's necessary. Crypto, election contracts, nothing. That's fine. Thanks, everyone.
So we're going to jump right into the next panel here, the third and final panel of the day, which will discuss the future of the Treasury cash market. I'll be handing the discussion over to Josh Frost, who will moderate the panel. Josh is the Assistant Secretary for Financial Markets at Treasury. Before serving as Assistant Secretary, he was the co-chair of the Liquidity Program for systemically important financial institution supervision at the New York Fed, and spent almost 2 decades there in the markets group in a variety of positions. Josh, I'll hand it over to you.
Great, thanks, Brian. Maybe I'll first start by saying in the marathon that is today's conference, we've entered Central Park. It's the last panel of the day. So when the member staffs were discussing panel topics, one of the issues that came up was, should we think about the importance of accurate marks? I think that was misinterpreted because the first 2 panels had 4 marks on them. So maybe we'll work on that for next year. In all seriousness, the last panel today focuses on the future of the Treasury cash market. I think this conference has been a helpful reminder of just how important it is for the public and private sectors to have a venue to discuss the current state of the Treasury market. We've heard today from a wide range of official sector personnel and a range of efforts being pursued to improve the resilience of the Treasury market, and from 2 panels on liquidity and non-centrally cleared bilateral repo. Okay, but what does everything we've discussed so far mean for the future of the market? So none of us have a crystal ball, but we are lucky today to have 4 panelists from different corners of the market, hopefully with a range of views that can help us identify a few potential future states. I'm looking forward to what should be an informative and interesting, maybe even fun, discussion about where we might be headed. I'm going to go through and ask each of the panelists their expectations over the next 5 years. Where do we think the net result is of all the official sectors' efforts to improve the Treasury market's resilience? How do we think that structure might evolve? And then pivot out even a little further to the next 5 to 10 years, thinking about the impact of technology and how intermediation might look in the longer term, and leave a little bit of time, hopefully at the end, for some Q&A. But before we dive in, I'd just like to start by briefly introducing our exceptional panel today. First, Deirdre Dunn. Deirdre is the head of global rates at Citi. In this capacity, she oversees the sales, trading, and origination businesses of Citi's global rates franchise. Deirdre is also the chair of the Treasury Borrowing Advisory Committee. Next, we have Greg Peters. Greg is the co-CIO of PGIM's fixed income, and is also one of the co-heads of its multi-sector team. Shyam Rajan is the global head of fixed income for Citadel Securities, with responsibility for the firm's fixed income risk and research functions. He oversees the institutional sales and trading business, as well as the quantitative research, algo, and independent principal strategies teams. Finally, Josh Younger. Josh is a senior policy advisor here at the New York Fed. He leads the analytical work related to financial markets and advises senior leadership at the New York Fed and Federal Reserve System on market structure issues and financial conditions and stability. So let's dive in. As highlighted in the recent Interagency Working Group Staff Progress Report, and as we've heard a lot about today, the official sector is pursuing a host of proposals intended to make the Treasury market more resilient. Let's just imagine for a moment we're sitting here, it's the 2028 Treasury Market Conference. How do you think all of the official sector efforts that are currently underway, let's assume they've all been implemented in some form, how do you think the Treasury market will have changed as a net result of all of the efforts currently underway? Maybe we'll start with you, Deirdre.
Sure, thank you. Thank you so much for having me today. It's funny to think about 5 years forward, really anything 5 years forward. And thinking about trading treasuries for the next 5 years slightly reminds me of something that people say often, I feel like, at least to me, about having kids, which is that the days are long and the years are fast, right? So I would imagine we're going to get there sort of before we know it. I think it's hard to differentiate between just the policies and things being explored right now and general market development. So I feel like to answer the question thoroughly, you kind of have to incorporate both. But I think two sort of main areas that I would highlight that I would expect. One is I would think things will be more transparent. And the second is that I think the market will be more efficient. And examples of what I mean in those two categories, if I think about transparency, I think it's probably continues to be increased data. I think clearing will bring, it's pretty safe to say we will have more clearing 5 years from now than we have today. And that will bring some increased transparency. I think very similar to the comments that Chairman Benham had, I think developments in AI and technology will help to create better surveillance tools for market participation, better controls around how we engage with the market as we learn from those surveillance tools. In terms of efficiency, I think all of these efforts should contribute to less fails in the system, at least on a relative basis. Relative to the size, obviously, of the market, increased operational efficiency, hopefully reduced dependence on human and manual processes, therefore reducing human error, and probably increased speed of transacting. Among those two things, I think there are both of those will sort of lead to some other factors that will evolve in the market, which I would love to just take the opportunity to highlight. One is I think we'll continue to see more bifurcation between on the run and off, deep off the run securities, or futures and deep off the run cash. I think probably some of the bifurcation we've seen over the past 5 years will continue. I think we'll probably see increased specialization of providers, whether that's liquidity providers or providers of clearing services or providers of settlement services. I think, as technology evolves, I think you'll start to see more sort of niche specialization there. And I think with increased data and clearing and everything else, I think the role of sort of passive investing or portfolio level trading will continue to increase in the Treasury market.
Thanks. Greg?
No, I think the changes that have been made and the latest paper, I think, by the working group has been fantastic. I think details matter, though. And I think transparency and the move towards that has been great. The question I ask, though, is investing in cash treasuries any different, right? So we're talking about trading. Trading is one aspect, but investing is the other. And so there's lots of talk, of course, around the basis trade. And I think to pull back the curtain, you need to ask yourself, why are asset managers not investing in cash treasuries, right? And I don't think that's really been tackled. So I think this has been fantastic, but it misses the central point, which is there's a lack of interest in owning and investing in treasury securities. So I think they're two very different things, the function versus the investment side. And I also haven't seen anything really tackling that issue to date. So I'm here to represent the asset management side, so I'll just kind of throw one thing that I think is interesting. So in a 40 Act mutual fund, owning future doesn't count as leverage and doesn't count as a cost in your expense ratio. However, if you do a repo, that counts as leverage, and it counts as a flow through into your expense ratio. So it's really hard from an asset manager, mutual fund owner, to get over that hurdle, which is why you see this tremendous interest in using futures instead. So I think there's been lots of great work that's done. The only other thing I'd throw out, not to be like super negative here, by the way, because I think it's really positive, is that I think we've made a safer ecosystem under the curve, but the tail risk remains. And I don't think we changed the fact that the lender of last resort remains the Fed. And I think at some point we need to break that cycle.
Great. Thanks, Greg. I'll just note, it's interesting, there was no panel discussion on the basis, but it's come up in every single discussion. every official sector, Keynote. Maybe that's something for us to think about for next year. Shyam.
Sure. I guess I'll take the slightly more negative view.
More negative than mine?
I think to the extent that regulation focuses on limiting individual financial actors or individual trades, we're going to be sitting here in 2028, with mutual funds not being able to invest in treasuries, or hedge funds not being able to take leverage, or dealers not being able to increase their capacity. We're just going to be dealing with some of the market participants here talking about the same kinds of issues. So I think regulation overall should focus on the healthiness of the ecosystem as a whole, as opposed to the individual actors or the individual trades that are going on. So what do we mean by that? Like in treasuries, the 5 working streams that the IAWG has established is very positive, but the implementation has devolved into, let's limit the scope of each of these things. Let's go into repo clearing without addressing the 2A7 money fund problem. How are we going to get them into a loss mutualization framework? Let's go to transparency, but let's leave out the entire central bank industry that's $5 trillion in our market. So we can't go forward with these and expect great results when we leave out large chunks of the market. So to the extent that the idea that things being centrally cleared is good, and the idea of greater transparency is good, but whenever we go into implementation, we never want to attack the harder problems, and we just choose some asterisks and say, let's get hedge fund leverage down, or let's get mutual funds to react in a different way. So I think the way to make this more successful is to attack those harder problems in terms of market-wide solutions that get in all cash lenders, all traders in the market, into these working streams, as opposed to doing targeted, tailored solutions to individual people.
Thanks. We've gotten progressively more negative. Josh, please tell me you're not going to get darker.
End with the Fed guy
Yeah.
to talk about how this angle. So I am more optimistic than that. And I think the key, which is what Deirdre raised, is data and the quality of the data. Something President Williams talked about is something everyone wants, like transparency, at least to the official sector, because even as the official sector, there are certain segments of this market that are somewhat opaque. And so I think the CFTC experience is really useful because we had a clearing mandate there that we imposed about 10 years ago. And I think one of the primary benefits of that was visibility into the market. It was sort of like the ability to run these kind of like very complicated, especially since data science has gotten more sophisticated, very complicated, very sophisticated statistics on it, and try to like pick up signals. And so when we have questions as the official sector as to what is going on, we're going to be in a much better position to answer them. And there's a tremendous value in that, because then you can get ahead of the game. And so we talked about the basis trade a lot in this panel as well. I'm not going to talk about the basis trade. That's just an example of something that is hard to track unless you have all the information. So that, I think, is in some sense the primary benefit of a lot of what we're talking about. The elasticity provided by a central clearing mandate, I think, is somewhat ambiguous. It's hard to say in advance. There's arguments on both sides of that. The utility of reducing settlement fails is sort of like, it's obviously good to do that, but the impact on actual market and trading activity is somewhat ambiguous. And so like the thing that we know, that's what I was trying to think about for this question. What do I have conviction about? It's the value of the data that we'll produce out of that.
Thanks. Maybe let's pivot now a little bit to market structure. So the structure of the Treasury market's evolved quite a bit over the last decade or so. As you look across the market today, you see a slew of market participants that offer liquidity provision under very different business models with different ways of trading treasuries, with a lot of this being driven by evolution in technology. What do we think are the most important trends that are likely to drive execution protocols over the next, say, 3 to 5 years? What's driving those trends, and how, if at all, do you think this is going to impact demand for treasuries, behavior of investors, and ultimately liquidity? And maybe this one, Greg, I'll start with you if you don't mind.
Yeah, so I don't see it changing. Like, you go back to basic principles, what I was driving at the first time, I don't see it changing demand per se. I think it allows for better function. I think that's critically important, so I don't want to minimize that, but I don't think it changes the demand side of the aisle. So I continue to separate out those two factors, and having a higher velocity trading market is good in some respects. It's bad in some others, of course. But I don't think I've seen anything to kind of go after the demand side and increasing the demand. Maybe it's a marginal, more trust around execution, so on and so forth. But I don't think it's a game changer as far as the fundamental issue that faces U.S. cash treasuries.
Thanks. Sean?
Sure. So I think we can differentiate between the on-the-run market and off-the-run market, as Deirdre said. The on-the-run market has evolved into largely like a cloud-based protocol. I think where that is heading, it's interesting, is taking more of an FX route, where it is going into a large number of disintegrated cloud pools. You have seen this in the rise in the last 2 years in a lot of private cloud streams that have come up. It used to be that market activity was concentrated on BrokerTec, and that has kind of dissipated right now. In the off-the-run market, it is still largely an RFQ market, and the RFQ protocol dominates. In RFQs, I think like the universal truth across all asset classes is the size of your RFQ is inversely correlated to the number of people it is sent to. Right? So it's still a trust-based market. The larger amount of risk that you want to move, the fewer people you want to inquire on it. So evolution to an all-to-all protocol is good, but it really doesn't solve the size issue. Everyone says all-to-all protocol has made great headways in corporate bonds, but we largely use all-to-all protocols in corporate bonds for really small size trades. So when you have to process a large number of small size trades, all-to-all protocol is good. When in the Treasury market, you deal with a sizable number of, or I should say a small number of large trades. And moving small number of large trades require dealer balance sheet, requires trust in the person that you're inquiring with. So I don't see the all-to-all protocol as necessarily a panacea for solving the off-the-run liquidity problem. But in terms of evolution, it can definitely help on the edges in terms of to the extent that people have a lot of month-end trades to move, which are smaller size and this thing. But we are dealing with a market where the largest transactions happen where a reserve manager has to sell treasuries because there's an earthquake or there's a war, and moving those large size transactions is never going to move to an all-to-all market.
So it sounds like, from your perspective, it's a, I don't know, universal truth or something about the market that's unlikely to change. It's not a technology limitation where 20 years ago, a lot of trading was happening over the phone because that's how trading was happening. It sounds like, in your view, this is not likely to evolve in the next 5 years meaningfully because of developments in technology. You still think that most of the off-the-run activity is going to take place over an RFQ platform?
I think that's a good summary. I think moving from phone to moving to RFQ is not really an evolution. It's just you're removing the intermediate salesperson to transact over the web, but it's not really a change in the execution protocol. It's just the way you consume and book a trade. But like I said, as long as the market still focuses on large size transactions, it is hard to see how the negatives of information leakage and the toxicity caused by that will outweigh the benefits of moving to an all-to-all protocol.
Josh?
Yeah, so just taking a step back, like what is the problem? When we talk about technology, the first question would be, what problem is that technology going to solve? What problem does the Treasury market have now that it will have over the next 3 to 5 years, for which technology is the solution? And the story of the past 10 years has been limited dealer balance sheets and technology used as a way to move more risk through the market on a gross basis without using as much of that balance sheet. So very high efficiency trade matching, and that's kind of what PTFs do, right? I mean, they very quickly move risk around the system so that it's less likely to be sitting at the end of the day to be held in inventory. And so this is the direction of travel is kind of like NASA in the 90s, better, faster, cheaper. And so I think technology is going to push us in that direction, but it leads to, I'm really glad you brought up private clubs and bilateral streams, because there's a segmentation problem with that, which actually I was going to talk about in the 5 to 10 year window, but we can talk about it in 3 to 5, because precision is not really part of this exercise. And the issue is when you segment the market, you have 2 issues. One is you lose visibility, And so a lot of these private dark pool type arrangements are very hard to monitor. So when we talk about liquidity, there are a bunch of charts before with market depth. That's all broker tech market depth because it has good data. So what if broker tech represented a smaller share of the actual interdealer market, interdealer trading? So there's where we lose visibility. So we gain visibility on positioning. We lose visibility on liquidity conditions. And so it'll be a harder market, kind of equity exercises the market. Whether that works for off the runs is an open question. I would assume that there is some efficiency to be gained there through automation, through all-to-all trading, even if it's only small tickets. There's lots of small tickets, and if those get matched very quickly, you could take a lot of the load off of dealers. But broadly speaking, that seems to be the direction of travel.
So you mentioned the NASA analogy of better, faster, cheaper. I guess recent cyber events kind of bring to mind, okay, better, faster, cheaper. One of the corollaries there is, well, it's kind of okay if things blow up from time to time in better, faster, cheaper. Do you think that holds in the Treasury market? And kind of get a sense of, is it okay if there's fragmented clubs around the market, if one of them has an issue, the market's still okay and robust, versus if it was all in one place and there's an issue, we have a problem?
Yeah, I don't want to stretch the analogy too far.
Okay, fair enough.
But so to the blowing up part. But yeah, I mean, a system that's sort of like internally redundant is a good system. So what you want is the mattress on the highway problem, which slows everyone down, but they can usually avoid it. And no one likes that outcome, but at least not everyone's running into the thing. And so, based on what the market has done over the past couple weeks, like things are trading reasonably well. So like that seems to be the outcome. Like, will that be the case in a more fragmented system? It could go either way. And it depends on the level of interconnectedness. And that's where visibility is really important.
And to be very clear, I am not in favor of a Treasury market that has small blow-ups from time to time. Okay, Deirdre.
Yeah, I would just sort of underscore some of the comments already in terms of the difference between very large transactions and volume of small transactions, and the difference between on the runs and off the runs, because I think the evolution it needs to be very different across the two. I think, the rise of increasing significance of passive investing, if you look at the volume that goes through a number of tickets on a month end now versus a year ago versus even 3 months ago, probably, the pace of change there is very rapid. And I think the market is keeping pace, but I would imagine that we will continue to, as a market, to develop new tools that help to facilitate a lot of those transactions. And on large sizes, and especially in off the runs, I would highlight, we actually, RFQ may not be that different than voice, but in times of extreme stress, we see clients move more towards voice even. So I think, there is, in times of stress, I think people back away from some of the tools that are used on a more regular way BAU basis.
That's a good flag. All right, believe it or not, I think we're through the easy part. We're through the next 3 to 5 years where there's at least some sense of what's going to happen. Let me make this harder, and let's look out 5 to 10 years. And I want to start maybe with a particular focus on technological trends and developments. So from digital ledger technology to AI, they get a lot of the press. There's a number of other emerging technologies that maybe get a little bit less attention. Curious what you all think about the impact of these emerging technologies in either direction, either positive or negative, on the Treasury market, on cash trading, on demand, over the next 5 to 10 years. And Shyam, maybe I'll start with you for this one.
Sure. So there's a lot of headlines recently about AI. Everyone's focusing on it. I think it's important to differentiate the two aspects. Market makers like us have been using machine learning for well over a decade right now. So numerical AI models have been present in these markets for a good part of 10 to 15 years. The recent popularity in the media has been because of large language models, because people can interact with it and see an immediate impact. It is tough to see in trading and investing functions how that really changes what we do, even on a 5 to 10 year horizon, because you're as good as your training set, right? And I'm sure Josh can talk to this better than me, but if you trained your model on what interest rates in Europe would do based on what happened in the 90s and 2000s, you're not going to be predicting negative rates. That function still requires somebody to invest capital based on an economic analysis. That said, where I think it can make a sea change is a lot of the middle office and back office functions in fixed income are very, very antiquated. We saw this with the last week attack. We have single point of failures with clearers. This is where I think technology will make the largest change. I think we'll increasingly find that the front office functions of trading and investing are not able to move forward because we have not modernized the middle office and back office structures. So where technology is going to help us a lot, I think, is in terms of modernizing that portion of the fixed income market. I think to really make a difference in investing, the numerical models are already in large uses, and anything that requires repetitive analysis is already being captured by numerical analysis. Large language models, less so. Maybe on the margin you get a couple of people reading Fed statements and refunding statements and coming out with something smarter than the analysts do, but that's, it's not going to be a game changer in 5 to 10 years for the investing function, I think.
Josh?
Yeah, so I'll go one step further than that. I think we'll learn our lesson with AI, I guess. It's good. I have a sense that, at least from an investment management standpoint, and this goes to the point you raised, if the information you have available today doesn't have enough information about what's going to happen tomorrow, there's no complexity that you can apply to analyzing that information that's going to get you a better outcome in forecasting the future. And so, generally speaking, the pastiche that AI represents now, we're kind of assuming that it's going to get much better than that, and I guess I'm just generally skeptical that that's the case. Aside from Taylor Swift lyrics in the style of haiku or something like that. I mean, it's very good at that. And so the question is the trend will push people towards using this for investment decisions, and that's where I think they'll learn their lesson. And my sense is that sort of the automated version of investing is going to follow the arc of video games over the past 30 years, which they got more and more photorealistic. I know when I was in college, everyone wanted the highest graphics resolution video game that looked just like real life, and now kids play Minecraft, right? And so back to basics, right? And that's the process of recognizing that in the investment case that you're relying too much on the internal logic of these machines, and it's really just replicating the past.
So you think we're going back to all phone-based trading? Is that what you're saying?
Okay. And written tickets.
Yeah, exactly. Handwritten tickets. Sounds
Books
good.
and records. We talked about cyber. On paper. Yeah.
Deirdre.
I would agree with what's been said. I think the impact will be more in sort of middle back office operations, the way we process trades, the way we process information about trades, I think will probably change. I'll be interested to hear Greg's view, but I would expect it to be less on the investment decision or premise to start with. That said, I think as we evolve collectively, the industry, I think, as is always the case, especially with the Treasury market, just given the role that it plays in the global financial system, sort of proceeding with care and caution and, extreme due diligence is going to be critical as, new technologies come online and people do sort of experiment with different ways of using them.
Yeah, so I would break it into two things. One aspect is the blockchain aspect. I think that's critically important. I think that's the stabilizing force. I imagine T plus instant in the future. I think that's not such a bad outcome. And then on the AI side, I worry a little more. And so I don't want to go down the Terminator route, but I am. So if you just oversimplify and you ask, kind of what the intent is and your fund, and it's, make money, right? So, make money, which oftentimes is in direct contrast to what the Fed and Treasury is trying to do. So I actually view it as a rather unstabilizing force, because I see those two agendas, moving further away, not closer together. So, maybe I'm wrong. The Minecraft thing, I'm not sure. What I see, it just continues to evolve, and we'll know when we know, and that's what kind of worries me a little. So that's the Terminator reference.
Can I, just to follow up on this for everyone, I'm kind of curious, the volume of trades that go through today on a T+1 versus cash settlement basis, 10 years from now, do you think, are you expecting to see improvements in efficiency where more trading's happening for cash because there's more tokenized treasuries. There are tokenized treasuries actively being traded because of settlement efficiencies, or is this mostly flash in the pan noise? People are still going to take a while to line up their financing, and the market is still going to look roughly like it does today with a T+1 versus cash settlement split. And whoever wants to start on this one, if anyone.
I can take it. I think the difference will be we will have the ability to be T+ instant. Whether we choose to use that, I think is more of a question mark. And this is where I think it's, even the Federal Reserve has to worry about this a little bit in terms of doing more research on what the reduction of available float in the market when there's no T+1 settlement, what it does to how reserves move in the system, et cetera. But I think the change will be we will have the ability to do it. Whether we choose to use it and move to that is a question mark.
Any other dissenting views? Okay. Maybe let's pivot a bit to intermediation a decade out. So we've seen an increase over the last several years, an increase in liquidity provision by relatively newer entrants into the Treasury market. Probably most notably the growth in the role of PTFs, particularly on electronic platforms, as we've talked about, focusing quite heavily in on the runs. But by contrast, dealers still play a really large role in facilitating risk transfer for off the runs. So as we look out the next 5 to 10 years, what do you think the picture for intermediation is likely to look like 10 years out? What is it going to take to catalyze whatever that future state you see is? What does it take to get us there? What are the opportunities that this provides, and what are some of the things we should be watching out for? Josh, I'll start with you on this one.
Sure, yeah, I think intermediation is an interesting frame. So we usually think of that as buying and selling, but the inventory management function I think is critical to what you're describing, because over the 10 to 20 year horizon, which is I think where we are,
Sure.
That's the easiest of the three, by the way. 3 to 5 years is the hardest because we actually get held to account on what would actually happen. So on a 10 to 20 year horizon, the growth of Treasury debt is in contrast to its use as a reserve asset, and what I mean by that is a reserve asset is something you think you can monetize quickly at low cost, at scale, and that relies on the ability of the banking system to expand and contract its balance sheet to accommodate that in a one-way flow. That was the 2020 experience. And when everyone chooses to do it at the same time, it's obviously problematic, but when you grow the stock of treasuries relative to the banking system, relative to the economy, that naturally gets harder. So that's the challenge, is to provide that elasticity that maintains the reserve status of treasuries, not as a foreign reserve asset, but just as a reserve asset in general, a cash substitute, which is the presumption a lot of investors have. And it reminds me of a very old problem, which was the 19th century agriculture problem. And these days I don't think about farming very much, but in the 1870s, cash receipts for the sale of crops were 30% of the money supply. And so your department used to box up cash to send to the Midwest to make sure that it was available. And so that was an annual exercise, but it's the same problem fundamentally, is I have a thing, but what I want is money, and I want to be able to sell the thing for money and not under duress. And so at the time, the national banking system couldn't provide that elasticity. That's why we're here now, right? This was the solution to that problem. When and how that becomes a problem again, and if, is sort of the central question. And repo is a version of that elasticity, because repo provides a way to functionally monetize treasuries through non-bank liabilities. And whether or not the banking system can provide it is another question. But I think that's going to be, it's sort of answering your question and sort of not, which is what is the challenge? I don't know what the solution is, because we also have a lot of reasons why we want some of the things that we have today that we talk about in this context. And so, but I think that's kind of the question we're really asking when we talk about the intermediation function. It's the provision of that elasticity.
So do you see treasuries a decade plus out as more or less money-like than they are today?
Depends on how we address it. In the steady state, you're just increasing supply relative to what's available to monetize, and so there's sort of a constraint there. On the other hand, a lot can change in 10 to 20 years, and some of the things we're talking about with the IAWG are reducing the monetary intensity of Treasury trading. When you do clearing, you're increasing netting efficiencies. When you do all-to-all, you're increasing netting efficiencies. We do this in payments all the time. So that's what CHIPS is for, right? Just to reduce the float that you need to facilitate large value payments. And so there are sort of technocratic solutions to this that are more about the way trading occurs rather than the constraints on the institutions that do the trading. But we have to be quite clever about that. I think cross-margining is another great example of a technocratic fix that aligns the risk, the loss-absorbing cushion, the capital in these trades, in a sense, with the economic risk, and that does lead to more leverage potentially, but it leads to more sort of like healthy leverage in the sense that the clearinghouses can exchange margin, and margin is more stable. So you have, I think it was raised earlier, we want stability in margin, not necessarily low or high margin, and so you can sort of achieve more leverage in a safer way through cross-margining type arrangements. You combine that with central clearing, and which is sort of a prerequisite, and all these things sort of add up to a partial fix. I just don't know if it's a complete fix to the longer run question.
I think my base case would be a just somewhat more extreme version of where we are now, where I think you see, increased bifurcation on the runs, probably the first few off the runs, maybe moving more in the direction of what on the runs look like now, but where the pace of evolution there is much faster overall. And so I think you'll see more divergence. I think though, when you think about the off the run market and the scale of it now relative to on the runs and the scale of what it will be 10 or 20 years from now, obviously, unless there's a material shift in the financing outlook, I think there will still be very much a need for negotiated liquidity and transactions there that won't keep pace with the evolution that we'll see in on the runs.
Can I ask from your seat, do you expect, again, this is the impossible question, so feel free to be wrong, because no one's ever going to hold any of you to account for the 10 to 20 year answer, exactly. So let's call it, like, just oversimplify the dealer PTF split of intermediation. Dealers playing about the same sized role a decade out, smaller role, bigger role as a share?
In on the runs or off the runs? Like,
maybe taking a turn.
Yeah, I'd say on the runs, I would say similar or smaller probably, and off the runs, similar. I mean, I think it is a very high percentage in off the runs, and I think it would stay that way.
Thanks. Greg.
I agree with Deirdre. I worry about kind of disintermediating the dealer. So all this talk around all and other trading platforms, I think it's important to have the dealers incentivized to step into the breach. And so if we create a system where they're not incentivized to do so, I think it creates more fragility into the market. The second aspect that I'm hopeful maybe that I'd like to see grow is the repo market. And so if you go back to kind of pre-GFC days, it was a 1-for-1 repo versus outstanding cash treasury. Now it's 0.25. And I think that hurts the function of cash trading. And so I'm hopeful that there's a solution to provide cost-effective repo financing to help with that. And then third, I do think the kind of characteristics, fungibility-based ecosystem needs to be more prevalent in the rate market. And what I mean by that is kind of using this ETF backbone or chassis where you create these kind of duration buckets that solve the needs for, whether it's pension funds, asset managers, whomever, that fill the void. And so that just creates kind of less risk around the end users who all they want to do is target a certain duration or fill a certain duration bucket. And today you have to go out and buy a treasury and roll and get stuck with off the runs and all this other stuff. So I think that's an important part of the ecosystem that doesn't get nearly enough attention.
Can I follow up? That sounds almost like you're suggesting what I'll oversimplify as like a TBA market for treasuries, where there's some specified set of contract parameters. I mean, the futures market kind of operates a little bit like this, but
kind of, but it's not. Created by the industry, right? And so you just look at. So I hate this example, but I'm going to use it anyway. So there's this ETF out there, T-bill, that people for some reason trade, and there's two QSIPs. Right? And so I don't quite understand it, but it tells you something, right? There's informational content in the fact that individuals or whomever is buying, and I suspect that it's filling a certain need that doesn't exist otherwise.
So to the tokenized treasury question earlier, it sounds like today ETFs are kind of the tokenized treasury, or like the T-bill one?
Yeah,
as an example?
yeah. So I think so. I think you're getting less idiosyncratic, CUSIP-driven world into a more characteristic world, that has issues itself as well. But I think it solves kind of more of the liquidity problems than many believe.
Thanks, Shyam.
I think what the official sector does in terms of transparency can play a big role in answering your question on what will happen 10 to 20 years from now. I know it's a hard problem, but I think blanket transparency in the market after we figure out what is the optimal size, what is the optimal delay, is much needed in this market. We are in one of the biggest markets and the least transparent market there is in fixed income, and that is an issue. And I think people underplay the positive impacts of transparency. The classic example I would give is, the belief is, okay, we have now kind of segregated on-the-run treasuries with off-the-run treasuries, but off-the-run treasuries itself have a lot of different segments. The price to trade 2 billion roll down 30-year bonds in the 10-year sector is very different than the price to trade 2 billion off-the-runs in the 30-year sector. So we are in this myth that treasury market liquidity is monolithic. I think putting data out there is going to show people the underlying turnover in these bonds. That automatically forces a conversation between the asset manager and their LPs on, hey, we own a treasury fund, but just so you know, the bonds underlying these don't actually trade that much. Then you get the market to self-regulate in whatever these trades may be, whether they're ETF-basis trades or treasury-basis trades. It's very easy for then an investor in a relative value hedge fund to say, this is the liquidity profile of this relative value hedge fund versus this is the liquidity profile of it. And we don't blanket say these are both treasury relative value hedge funds, they can never go bad. So I think to the extent that we push transparency more and more across all market participants, I think that forces the conversation for people to decide what protocol or what sort of intermediation will come around in this market. You're not going to incentivize more intermediation in off-the-runs, either by dealers or by PTFs, by making the market more opaque. People have to know what sort of data or how their book turns over and what their return on capital profile is and what their return on liquidity profile is before they agree to become liquidity providers. And I think the role of the official sector is to incentivize more liquidity providers in the market, be it the form of PTFs, dealers, however it is. So I think transparency will play a very, very key role in this.
So I know this has been a theme throughout the discussions today about incentivizing additional risk capital, market-making appetite. So you just mentioned transparency is one. I'm curious for anybody on the panel. Are there other steps that can be taken either by the official sector or that you expect to evolve organically in the market that will attract additional risk capital to market making in treasuries?
It's important to say what kind of risk capital. So like the equity FX markets are a great example of where the search for speed was paramount. And so there was all this, it's like they made a movie about it, right? With somebody whose name I forget. But like Michael Lewis wrote a book. And so like you're putting all of this intellectual capital into just speeding everything up. And I remember when neutrinos turned out they had mass, people were like, well, we can just fire them through the center of the earth and like trade Tokyo versus like the topics versus the S&P. Like that's not a good use of resources. And so like that's not the kind of risk capital you want to attract, right? You don't want to turn it into an arms race because that just increases overhead costs and like squeezes out and ends up with concentration risk just in terms of strategies, right? And so this is kind of like a caution, I guess. I'm not really answering your question, but that'll be my contribution. I think that's kind of the risk to just attracting capital generically.
I think it's also important to talk about at what price do you want the risk capital, because I think there is a clear distinction there. And I think transparency can help attract risk capital. It also could help to raise the cost of risk capital, right? Depending on what the turnover, can look like and what sort of the intelligence is around, what the data says around how much trades and everything. And I think, you can sort of make the same argument if you look at even rolling out clearing, which I think we can, we've talked earlier today about the broader benefits of having increased clearing. That will increase the cost of risk capital in many trades in terms of the support of the Treasury market. So you have to be thoughtful around what are those trade-offs. And along those lines, I would just sort of echo what I said earlier, which is that I think any new initiatives, any changes should really be taken with, good care and due diligence and sort of transparent communication over a time horizon that enables market participants to kind of make that adjustment, any adjustment needed in a sort of more methodical manner.
Okay, before we turn it over to audience questions, I just want to give my panelists one last chance. Anything we haven't covered about the future? Kidding. Okay. Maybe we'll turn it over to audience Q&A at this point.
Thank you so much. Great discussion. Maybe just turning the tables here a little bit. One question for you, Josh Frost. So a big part of the future of the Treasury market that I get asked all the time by clients is how do we think about issuance, especially in this context of very volatile rates and term premium and shape of the curve. How should we think about issuance, and how should we think about that in the context of a lot of liquidity right now, allowing Treasury to take advantage of bill supply? And what does the path forward look like?
Yeah. We would tell you the answer 10 years from now or next quarter. So maybe I'll kind of start with, or pick up where we left off with both with Nelly's remarks and with our last refunding statement. I guess I just go back to fundamentals and basics here, which is, the way we fund the government, the amount we need to fund is the input. And what we do is try to figure out what's the best strategy to get us there. And we've got a few kind of North Stars we use, our overarching goals to do it at the least cost over time to the taxpayer. And the way we think about doing that is by being a regular and predictable issuer in the market. Now, is that enough to predict, for a given path of deficits? Is the bill share going to be 10 basis points higher or lower than some baseline forecast you might have? Clearly not. But I think what we do is we try to engage with a broad array of participants in the market, a lot of folks in this room, the Treasury Borrowing Advisory Committee, the primary dealers, cast a pretty wide net to get the best advice we can on how to answer that question, both like 1 quarter out and 1 decade out. I guess the future is crystal clear to this whole crowd. Okay, I'm not seeing any other questions. I want please join me in thanking the panel today. Excellent. Thank you.
Thank you again for that lively discussion. We have one last and final speaker of the day. I'm very pleased to introduce Roberto Perli to provide some concluding remarks. Roberto is the manager of the System Open Market Account, or the SOMA, and a senior leader in the New York Fed's Markets Group. He's responsible for implementing monetary policy at the direction of the FOMC. He has over 20 years of financial services experience related to both monetary policy and financial markets. Before joining the New York Fed, he was head of global policy at Piper Sandler. Previously, he founded Cornerstone Macro, was a managing director at International Strategy and Investment Group, and started his career as an assistant professor of economics at the University of Pennsylvania. Please join me in welcoming Roberto.
Thank you. Thank you, Brian, for that nice introduction. And well, certainly thank you for the opportunity to offer some closing remarks here to what was yet another, fantastic Treasury Market conference. So before proceeding, actually, let me just say a couple of things. First of all, I want to thank the staff from the joint member agencies for convening such a diverse and thoughtful group and putting together such an engaging event. And also I'd like to thank the members of the market groups involved in making sure that this conference ran with, I should say, Swiss precision. Just having coming back from Basel, I think I know what I'm talking about. I think that's appropriate. All right, also let me say just, I'll take slightly more than the 5 minutes that the schedule allow me, just given what I have to say, but don't panic. My goal is to deliver you all to the reception as fast as possible, all right? So with that in mind, this annual discussion is a highlight, obviously, of the New York Fed calendar, and both for its ability to bring together a range of different participants and for the opportunity it provides to step back and think holistically about market design and structure. So the Treasury market is obviously critical for a robust and vibrant US economy, but the Treasury market can only serve this purpose when it functions smoothly and when its signals are not distorted by extraneous and idiosyncratic factors. So much of the conversation today is centered around how to ensure a well-functioning and resilient market, and that's a fundamental goal, of course, and I want to thank all today's participants for their valuable contributions in that area. In my remarks, I will focus instead on how a well-functioning Treasury markets can be helpful for understanding the economy and informing monetary policy decisions. So before proceeding, of course, make the usual disclaimer. These views are my own and do not reflect those of the Federal Reserve Bank of New York or the Federal Reserve System. So the Treasury market is particularly important from a monetary policy perspective because of many reasons. I'll mention just 3 here. First, changes in the price of Treasury securities provide important signals about the economic outlook. These signals are inputs into policymaker decisions, and it's crucial that they are as clear and as uncontaminated as possible, and that they are interpreted correctly. Second, short maturity treasuries and treasury repos are an integral part of the money markets and thus are central to the implementation of monetary policy. And third, treasury securities of all maturities are instrumental to the transmission of monetary policy, as many other market prices and loans are influenced by the prices of those securities. So we easily observe Treasury yields, of course, at all available maturities. So for example, we can easily see that Treasury yields have increased sharply between, say, July and October, and that have partly but abruptly retraced so far in November. The important question from a policy perspective is how we should interpret those swings. So first, and most importantly, from the point of view of what was discussed here today, we can say that the Treasury market appears to be functioning smoothly. So although a number of commonly used metrics indicate that liquidity is worse than it was in years past, those same measures are also broadly consistent with what one might expect given the current high levels of volatility. And if I could find the clickers, there it is. I can move on to this slide, and you can see the blue dot here where we are today is about where we should expect it to be given the volatility. And okay, I guess you see it now. I saw it there. Yeah, so the current conditions are in line with the volatility liquidity configurations. So we see no evidence of market dysfunction. It generally means that we can take Treasury prices and their signals as an accurate reflection of the views of market participants. That being the case, we must also be able to decode that valuable information that the Treasury market gives us. In particular, it's not enough to just look at Treasury yields because those can change for different reasons. Conceptually, observable Treasury yields are comprised of 2 unobservable components: the expected path of the policy rate over the life of the security, and the so-called term premium, which, as you know, reflects potentially many factors that are separate from monetary policy expectations. It is these unobservable components that are the most useful to disentangle in order to understand the signals that the Treasury market is sending us about the state of the economy. Precisely because these components are not observable, we need ways to estimate them from the available information. One straightforward way to do that is to look at survey measures of the expected future path of the federal funds rate, called those quote-unquote true measures of policy expectations, subtract them from the observed Treasury yields, and call the difference the term premium. The method has the advantage of being simple and devoid of assumptions that necessarily have to be made when dealing with models. But still, this method leaves something to be desired from a host of reasons. For example, survey results may not actually reflect underlying expectations because of inertia and other biases in responses. And moreover, survey estimates summarize the views of a limited number of respondents that often are not even actually actively trading, and most likely are not the marginal investor. So if we were to rely only on survey results to determine the term premium component of Treasury yields, we would risk misinterpreting the message embedded in those yields. So the alternative, as you know, is to use models. As one might expect, there are quite a few of those models, including several that were constructed by economists within the Federal Reserve System. Because models are constructed differently and rely on different assumptions and data inputs, they also produce results that at times can vary significantly from each other. And models tend to produce larger fitting errors at times of substantial volatility and uncertainty, which is, of course, precisely when we need them the most. So those are the kind of downsides. But on the positive side, models don't suffer from the same drawbacks of the simple method based on survey data that I just described, and instead are based on theoretically sound economic and financial principles. So since the two broad methodologies have their own pros and cons, I find it useful to look at all the information available from models and surveys and to form a view of what the Treasury market is telling us. And luckily, these individual methods produce different point estimates of the level of policy expectations and term premiums, but they also often agree on which components is most important in driving changes in Treasury yields at different times. This kind of, let's call it, kitchen sink approach helps us better understand recent moves in Treasury yields. And let me take just a brief detour, I promise, to the aftermath of the global financial crisis to put current moves into a better context. So for a long stretch of time of the post-2008 period, policy rates were pinned at the effective lower bound. Investors understood the Fed's forward guidance, and policy expectations did not move a lot over those periods. As a result, most of the changes in short-term interest rates and even a meaningful fraction of changes in longer-term interest rates were attributable to shifting term premiums. Long-end term premiums, as you know, were still volatile, were in fact estimated to be quite low, and actually were even negative for most of those periods. So that has changed significantly over the past 2 years, of course. Above target inflation is, in the wake of COVID-19, has put policy expectations firmly back in play as a driver of rates across the curve, and policy expectations appear to have increased throughout most of the cycle. As investors progressively adjusted up their estimates of how much the federal funds rate will have to be raised and how long policy would have to remain restrictive in order to bring inflation down. Model estimates of term premiums, while still volatile, appear to have been range-bound at a low level for most of the hiking cycle to date. But more recently, they have become significantly more important as a driver of Treasury yields. From the beginning of July to the end of October, 10-year Treasury yields increased by more than 100 basis points, as Nelly mentioned this morning. So while the models we monitor produce different point estimates, on average, at least, they suggest that term premiums account for the bulk of the change in yields over that period, as you can see from the left panel here on this slide, with only a modest fraction attributable to policy expectations at the right. And survey-based measures, which are the rightmost bars in both charts, put us on a similar ballpark. So these recent fluctuations highlight the importance of disentangling the unobservable components of Treasury yields, because if policy expectations were or had been the main driver of these recent swings in Treasury yields, one would have to conclude that investors believed that the underlying momentum in the economy was much stronger than anticipated over the summer and early fall, and then suddenly changed their mind earlier this month. This would have contrasted, obviously, fairly sharply with recent economic and inflation data, which, as you know, indicate robust growth, but also show evidence of moderating inflationary pressures. So it's equally, and I would say it's equally hard to understand in that situation why policy expectation would have so quickly and sharply turn around in early November. So what drives the term premium? Well, in light of some of the discussion that we heard here today, I don't think you will be surprised if I tell you that the broad uncertainty that surrounds the outlook is an important factor. Conceptually, as you know, higher uncertainty is a main determinant of term premiums. Sources of uncertainty abound these days, from, just to mention a few, questions about the longevity of the recent uptick in growth that we saw last quarter, to likelihood of further inflation or further disinflation for that matter, and so on. And there is also discussion among market participants about the reduced demand relative to the past from buyers who are less price sensitive, such as banks, central banks, insurance companies, pension funds, and so on. So at different points in time, these buyers have served as an important source of demand in volatile environments. And market commentators have also discussed the changing relationship between fixed income and equity returns as the economic effects of tighter policy play out with the usual long and variable lags. So it's also worth noting that the recent changes in Treasury yields have been concentrated in forward rates at a horizon beyond the next couple of years. This suggests that whatever has led to such sharp reassessment of term premiums, it is something that affects longer-term perception of risk and not something that might be just around the corner. Market participants point to several sources of that longer-run uncertainty, from changes in the underlying structure of the US economy and global economy as well, to the risk of secular widening of the federal fiscal deficit, fundamental shift in geopolitical balance of power, and other factors. So all of these factors can affect longer-term interest rate in ways that are not directly tied to the longer-run outlook for monetary policy. Now, also importantly, from our perspective here, most of the Treasury yields move recently has been driven by real interest rates, again, as Nelly mentioned this morning. I'm looking here at the difference between the blue and gray lines in this panel. Based on market pricing as well as survey data, including our own desk surveys, it's hard to conclude that longer-run inflation expectations are anything other than well anchored. Current levels, forward measures of inflation compensations, are well within historical ranges, while spot measures are at the high end of the pre-pandemic ranges, as we can see from this longer-term chart. A significant portion of the changes we observed recently can arguably be attributed to risk and liquidity premiums in TIPS markets, as well as swing in oil prices. In other words, they are not probably a pure reflection of changing inflation expectations. Now, Treasury yields and therefore term premiums are important drivers of financial conditions, since financial conditions can have implications for the path of monetary policy. As Chair Powell said during his most recent press conference, it's important to monitor and understand these movements and put them into the right context. Key question is whether higher term premiums will prove temporary or persistent. Estimating unobservable term premiums is hard enough, as I just mentioned, but unfortunately forecasting them is even harder. But in general, if factors such as the longer-run fiscal balance or the prevalence of supply shocks or demand shocks going forward will be the drivers of term premiums, well, it is possible in that case that term premiums will stay higher than they used to be for some time, and in that case, financial conditions are likely to remain tight, in particular tighter than implied by monetary policy expectations. Conversely, if the drives of the recent swings in term premiums were more short-lived and those sources of uncertainty dissipate, term premiums may revert back to lower levels and financial conditions may ease some. Because it takes time for financial conditions to propagate to the real economy, temporary episodes of tightening, no matter how pronounced, matter a lot less than episodes of sustained tightening. So to conclude, going beyond observable Treasury yields is crucial to disentangling the message the Treasury market is sending about the outlook for the US economy. The unobserved components of those headline yields give us critical insight into the nature of changes in market expectations. These insights not only inform policymakers, but also an important aspect of how monetary policy is transmitted to the real economy. As I noted at the outset, these channels and signals are only useful if to the extent that they are derived from prices that accurately reflect the views of market participants, and that emphasizes the critical role that a well-functioning Treasury market plays, not just as a benchmark for other instruments or as a store of liquidity, but as a tool for monitoring the health and evolution of the broader economy, as seen from the perspective of market participants. Substantial benefit of this conference is its contribution to safeguarding the efficacy of Treasury markets price signals, including the FOMC, ensuring that the FOMC has as much accurate information as possible to determine the course of policy and fulfill its dual mandate. With that, today's conference comes to a close. So thank you again, everybody, for joining us, and please join us downstairs for the reception and dinner. Thank you.